Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, when we think about trading, we get obsessed with strategies, charts, technical indicators, all that stuff. But what if the real secret, the thing that truly separates the legends from everybody else, isn't on your screen at all? What if it's inside your own head? Today, we're diving deep into Jack Schwager's classic, The New Market Wizards, to unlock the psychological secrets of the world's greatest traders. Okay, so this one quote, it's pretty much the whole game right here. It is a brutally painful lesson that most traders, well, they learn it way too late. And it's the #1 reason so many people fail. But let's be real, this isn't about the numbers on the screen. This is all about ego. Let's break down why. So if we want to get what makes a great trader tick, we actually have to start by looking at a total catastrophic failure. And the book, well, it kicks things off with this wild example that has absolutely nothing to do with stocks or bonds, but has everything to do with the psychology of being dead wrong in a trade. I mean, think about it from his perspective for a second. The potential reward was massive, right? Control over oil, new territory, a strategic coastline, and the initial risk? It seemed incredibly low, especially after the US State Department gave what felt like a very ambiguous response. On paper, it looked like the trade of a lifetime. But then, the market, so to speak, started to move against him. You had UN resolutions, the deployment of troops. These were all warning signals, basically screaming, get out, cut your losses now. A smart trader would have taken a small loss, maybe gotten out at break even. But no, he did what so many traders do when they're in a hole. He let his ego take the wheel. He doubled down, ignored every flashing red light, and just held on until he was forced to take that mother of all losses. And that right there, that's the trap. See, it's not the bad trade that blows you up. It never is. It's the stubborn, ego-driven refusal to admit you were wrong that turns a small little paper cut into a catastrophic wound. The market didn't destroy his position, his own mind did. And that's when it hits you. The real enemy isn't out there. It's looking right back at you in the mirror. Now, you might be thinking, okay, that's a dictator. What does that have to do with me? Well, the author of the book, Jack Schwager, he shares this incredibly honest and painful story that proves this internal enemy lives inside every single one of us. He basically opens up his own trading journal and shows us the ugliest parts. So picture this. Schwager is on an absolute tear. He's feeling like a genius, like he can't lose. He turns a small account into over 25 grand. And then it happens. The inevitable drawdown. He loses about a third of it. And instead of stepping back, he does the worst thing possible. He dives into what we all know as the revenge trade, a desperate Hail Mary on the British pound that sent him into a psychological spiral and just vaporized almost everything. And when you break it down, it wasn't just one bad move. Oh no, it was this domino effect of trading sins. First, pure greed, that desperate need to make it all back in one shot. That led him to abdicate all responsibility, just blindly following a friend's tip instead of doing his own work. Then, he started ignoring obvious market signals because his ego was now tied to his friend being right. And the final nail in the coffin? A complete surrender of risk control. He put his entire financial fate in somebody else's hands. So, totally wiped out, Schwager goes to see the legendary Ed Seykota, and Seykota drops this little gem on him. And this one sentence just completely turned his world upside down, forcing him to see that his failure had nothing to do with the market or his friend or bad luck. The cause was way, way deeper. Here's the crazy part. Schwager had this light bulb moment. He realized, deep down, he didn't even want to be trading anymore. He was burned out, stressed from building a house. He just wanted out. And by making one bad decision after another, he got exactly what his subconscious was screaming for, a reason to stop. This is such a huge insight. A lot of the time, what happens in your trading account is just your subconscious getting what it really wants. Okay, so if we're our own worst enemy, the obvious answer is to find a perfect system, right? Some holy grail that just runs on autopilot and takes our stupid emotions out of the picture. Well, the market wizards are here to tell you that's a trap, a huge one. The holy grail does not exist. In fact, the book opens with this quote from William Blake, and it's the perfect antidote to that holy grail hunt. The whole point isn't to find the best system out there. It's to build your system, one that's tailor-made for your personality, your quirks, your risk tolerance, your unique way of seeing the world. And if you need proof, look no further than these two giants. You've got Stan Druckenmiller, who's basically in a satellite looking at the entire global economy, interest rates, currencies, the whole shebang, to find his ideas. And then you have Richard Driehaus, who's doing the exact opposite. He's got a microscope out, focusing only on individual companies, completely ignoring the big picture. They have polar opposite approaches, yet both are legends. So what does that tell you? Well, that exact question, are traders born or made, led to probably the most famous experiment in trading history. It all started with a bet between two partners trying to settle that very argument once and for all. So the story goes, legendary trader Richard Dennis makes a bet with his partner that he can grow traders just like they grow turtles in Singapore. He took a group of regular people, total novices, taught them his exact mechanical trading rules, and then gave them real money to trade. And the results were just mind-blowing. Many of them became hugely successful. So the answer is yes, you can teach a winning system. But here's the real kicker. The secret wasn't the rules themselves. The real holy grail was having the guts and the discipline to follow those rules day in and day out, especially when you're losing money and your emotions are screaming at you to do something else. So if there's no single magic formula and their methods are all over the map, what is it? What do all these wizards have in common? What are the universal laws that they all live by? Well, it turns out they do share a secret playbook. Well, let's start with this quote from Jim Rogers, which I think just says it all. This reveals the first and maybe the most critical principle, patience. And I don't mean just regular patience. I mean a superhuman, almost unbelievable level of patience. Think about that. The average person is clicking buttons because they're bored. The pros is doing nothing, just waiting. And another trader in the book, Mark Weinstein, gives us the absolute perfect analogy for what this looks like in practice. See, professional trading isn't about being a hyperactive gunslinger. It's about being an apex predator. The cheetah, right? It doesn't run after every single animal it sees. No way. It just waits and waits, conserving all its energy for that one high probability shot. Only when it's absolutely sure it can succeed does it strike. That is professional trading in a nutshell. They are not in the market for excitement. They are perfectly happy to sit on their hands, doing nothing for weeks or months, waiting for that one perfect setup. And look, patience is huge, but it's part of a bigger code. It's this whole mindset built on these core pillars, the discipline to actually follow your plan, the obsession with risk management before you even place a trade, the courage to ignore the crowd and think for yourself, the humility to know when you're wrong and get out fast, and underneath it all, an insane work ethic. This is the code. They all live by it. Oh, right. So this brings us to the last and honestly, the most important lesson in the whole book. After you hear all the stories and all the strategies, you start to realize that the path to mastery isn't about looking at charts. It's about looking in the mirror. And this famous quote from the old Pogo comic strip just nails it. The book uses it to summarize everything. The fight isn't against the market. The real enemy is your own impatience, your own greed, your own fear, your own ego. The entire war is fought between your own two ears. And that's why this is the single most important takeaway. You have to find a trading style that fits you. Because if you're a patient person trying to scalp minute charts, you're going to go insane. If you're an impatient person trying to hold for years, you're going to fail. If your personality and your strategy are fighting, your personality is going to win. Every single time. Real success only happens when the two are in perfect harmony. So at the end of the day, that's the real secret, isn't it? The market is just a giant, very expensive mirror. It will reflect every single one of your flaws, your discipline or lack thereof, your fears, your hidden desires. It will show them to you with brutal, unforgiving honesty. So the question you have to ask isn't, how can I beat the market? The real question is, what is the market going to show me about myself? Because whatever that is, that's the key to everything.
All right, let's jump right into a fascinating story from a market expert. But here's the twist. This isn't about some legendary win. Nope, it's about a catastrophic loss. We're going on a journey through a series of trades that taught him one of the most profound lessons you can ever learn about yourself and about the psychology of the markets.
This right here, this was the author's #1 cardinal rule. The one principle he absolutely lived by. It was the bedrock of his entire trading philosophy. But as we're about to see, even the most disciplined people can be tempted to break their own rules. And that sets the stage for a really, really painful lesson.
So here's how this whole cautionary tale breaks down. We're going to start with this idea of scared money, then see how it looked like a perfect trade led to a total cascade of errors. And then we get to this powerful encounter with a legendary mentor, and that's where the final, pretty shocking lesson is revealed.
So let's set the scene. Why wasn't our guy trading? Well, it's pretty simple. He was building a house, and it completely drained all of his risk capital. I mean, he even liquidated his entire commodity account just to pay for an indoor swimming pool. On top of all that, he was just mentally exhausted. He flat out did not want to trade. So wisely, he was sticking to his big rule.
And this is exactly why that rule is so critical. When you're trading with scared money, money you truly can't afford to lose, it just messes with your head. It completely clouds your judgment, you get scared, you pass up on great trades, you panic and sell a good position at the first tiny dip, you snatch these teeny tiny profits because you're afraid, and maybe, worst of all, you freeze up on a losing trade, just like a deer in the headlights, totally unable to act. It's a guaranteed recipe for failure.
But then, you know how it goes. Even though he decided not to trade, a setup appeared on his charts that was just, well, it was too perfect to ignore. He had this rock-solid conviction that the British pound was about to totally collapse. It had dropped hard for 2 weeks, and then it just settled into this super narrow sideways pattern. And in his experience, that was a classic, flashing sign that another huge drop was coming.
You can just feel the struggle here, can't you? He knows he shouldn't be in the market, but his gut, his analysis, it's just screaming at him. He actually puts it off all day, but then the market closes and he gets that feeling, that nagging feeling that he's made a huge mistake by not acting, so he does it. He places an overnight order to short the pound, and the next morning, boom, it opened down over 200 points. He was right. And just like that, he was back in the game.
The legendary investor James Rogers put it perfectly with this quote. It's funny, right? By not wanting to trade, our author had accidentally mastered patience. He was only willing to jump on a setup that was so obvious, so compelling, that it felt like picking up free money just lying in the corner. And you know what? It was working.
And here's the result. His account, which he started with basically nothing, just grew and grew over the next few months. His decision-making was laser-sharp, his patience paid off, and his equity ballooned to over $25,000. It really seemed like his reluctant return to the market was an absolute stroke of genius.
And then, this is where things start to go sideways. After a string of bad trades chopped his profits down by about a third, his gut was telling him to pull back. But then, he gets a phone call. It's a fateful call from a friend named Harvey, who is a big believer in the, let's say, complex and often controversial Elliott wave theory. That's the one that tries to predict market moves by finding these repetitive wave patterns in crowd psychology.
The conflict here is just crystal clear. You've got his own experienced, cautious instinct on one shoulder saying, whoa, you never ever sell into a runaway bull market. But on the other shoulder, you have his friend Harvey, who is absolutely certain, calling it the market's last gasp and telling him he has to sell right now. And because our author was already bruised from his recent losses, he was tempted by what looked like an easy way to get it all back.
Okay, so let's walk through this train wreck in slow motion. He takes Harvey's advice on Friday afternoon. By Monday morning, bam, the market gaps 220 points against him. His own trading rules are screaming, "Get out now!" But he defers to Harvey. All week long, the market is flashing more and more warning signs, but every time he sticks with his friend's analysis. A week later, the loss is just massive, and he finally throws in the towel.
It was such a classic psychological trap. You can see how one sin just led to the next, like a snowball rolling downhill. It all started with greed, that desire for a shortcut to win back his money. That led him to break his core rule of never, ever being swayed by someone else's opinion. And once he broke that rule, he started ignoring his own gut feelings. And the big one? By handing over the decision-making, he gave up all control over his risk.
So after this absolutely brutal experience, our author just stops. He's done trading. Months go by, and he's at a seminar where he meets Ed Seykota. Now, if you know anything about trading legends, you know Seykota is a different kind of cat, famous for this unique blend of hardcore analysis, deep psychology, and a great sense of humor. He was hoping maybe Seykota could shed some light on what went so wrong. And Seykota's perspective was unconventional, to say the least. It's perfectly captured by his hilarious magazine cover theory. He basically argued that big financial magazine covers are the ultimate contrary indicator. A cover screaming, "Are interest rates going to 20%?"
That marked the absolute bottom for the bond market. Another one about oil prices going to the moon, that marked the exact top. His advice was simple: just read the covers and do the opposite. This was the kind of wisdom he was known for.
So get this scene. They're in the noisy lobby of a hotel, there's some terrible lounge band playing in the background, and our author is just pouring his heart out, recounting this whole trading misadventure to Ed Sikota. He's just hoping for some kind of profound insight, some key to what happened.
He tells Sikota that at his peak, he was up about 20 grand. And here's the ironic part. He was looking to buy a new car that cost, you guessed it, exactly $20,000. It was so tempting, a real tangible reward for his trading. But he just couldn't bring himself to do it. He felt like if he cashed out for a car, he'd always wonder, was this his one big chance to finally make serious money?
So after hearing this whole long, rational, complicated explanation, Sikota just cuts through all of it. He looks at him and asks one simple, direct question that changes everything. He just says, "So why didn't you close the account?" And that question just stopped our author dead in his tracks.
And then Sikota delivered the knockout punch. This one sentence completely reframed the entire disaster. And suddenly it was clear. The problem wasn't Harvey, it wasn't Elliott wave theory, it wasn't even greed. The real problem was that deep down, our author was just looking for an excuse to get out of the market.
See, this was Sikota's most profound belief. Everybody gets what they want out of the market. And in that one moment, our author realized what he truly wanted. He never actually wanted to be trading in the first place. And the market, in its own brutal way, just gave him exactly what he was asking for, a reason to stop. He lost the money so he could finally quit. And this brings us to the final, huge lesson of this whole story. The moral isn't just about risk management or listening to your gut. It's something bigger. It's that you don't always have to be in the market. Sometimes the absolute best trade you can make is no trade at all. To really win, you need two things to align perfectly. You need confidence in your analysis, and you need a genuine, powerful desire to actually be in the game. When our author started, he had the confidence, but he didn't really have the desire. By the end, after that disastrous trade, he had neither. The next time he trades, he says he's going to make sure he has both.
And so that really leaves us with the final question. Sikota's incredible insight forces all of us to look past the charts and the strategies and ask something way deeper. If everyone truly gets what they want from the market, what is it that you, consciously or maybe even unconsciously, are really trying to get?
Sometimes the most powerful lessons in decision-making come from the most unexpected places. Today we're going to talk about one of those. We're looking at Saddam Hussein's invasion of Kuwait, and how this one single catastrophic blunder can teach us pretty much everything we need to know about cutting our losses. So here's the big question, right? How can a massive geopolitical event, a war of all things, be the perfect metaphor for a bad stock trade? Or maybe for that career path you've been on for way too long, or really any decision where you feel like you're just too invested to quit? Well, as you're about to see, the parallels are kind of shocking. And this is it. This is the main takeaway right up front. The single most dangerous mistake any of us can make isn't getting it wrong in the first place. I mean, everybody makes bad calls. The real danger is that stubborn refusal to admit you were wrong and just take a small loss early on. Because that inability to accept a small defeat, it almost guarantees you're going to face a catastrophic one down the road. Okay, so to really understand how this all went so wrong, we have to go back to the very beginning. We're going to look at the invasion of Kuwait not just as an act of war, but as a calculated, strategic trade, a high-stakes investment that at the time seemed like it had a brilliant risk-to-reward setup. So let's be super clear about this analogy we're using. When we say Hussein's trade, we're talking about the 1990 invasion as a calculated bet, a bet with what he saw as massive potential upsides, and, really importantly, risks that he thought he had completely under control. You really have to put yourself in his shoes for a second. From Saddam Hussein's point of view, this calculation was a no-brainer. This wasn't some reckless gamble. It looked like an A-plus opportunity. The potential rewards were absolutely enormous, while the initial risks, they seemed tiny. Let's start with that massive upside. I mean, just look at this list. This was about way more than just grabbing some land. This was a brilliant strategic move, or so he thought. By taking Kuwait, he could single-handedly drive up oil prices, which would be great for Iraq's economy. He'd get rid of a rival who was breaking OPEC quotas. He'd get their huge oil fields forever. And on top of all that, he'd get a strategic port on the Persian Gulf and, of course, a massive boost to his own ego and power in the region. The potential payout was just immense. So what made the risk seem so low? This is the absolute key. It was the initial signal from the United States. The State Department basically came out and said, it's a regional dispute, not really our problem. Now, for a guy like Hussein, that kind of vague statement was practically a green light. It was a sign that the biggest player on the board was just going to sit this one out. But you know how it goes in trading and in geopolitics, for that matter. The situation can change on a dime. The market that looked so friendly was about to turn on him, hard. And as we're about to see on this timeline, the warning signs, the signals to sell, started popping up almost right away. This timeline just lays it out so perfectly. First, President Bush sends troops to defend Saudi Arabia. That's signal number one, a huge one. At this point, Hussein could have probably negotiated a withdrawal, maybe kept a few small wins and walked away with a profit. But he held on. Then the U.S. doubles its forces. That's not just a signal. That is a giant flashing red light that the game has completely changed. Still, he holds. And finally, the UN sets a hard deadline. This was his absolute last chance to get out at something close to break even, to pull back and just salvage the whole thing. And he ignored every single one of them. So why? Right? Why would any leader or any trader or any of us see such clear red flags and just do nothing? Well, the answer lies in one of the most powerful and frankly dangerous psychological traps there is, the sunk cost fallacy. And this right here, this is the mantra of the trapped investor, isn't it? It's the sound of hope just completely steamrolling logic. The goal isn't to make a profit anymore. The goal has shifted. Now it's just about avoiding a loss. All your focus is on the past, on what you've already put in, instead of looking at the future and where things are obviously headed. So once that January 15th deadline came and went, there was no turning back. The bombing started. And at that exact moment, the trade wasn't just in trouble, it was officially in the red. It was an undeniable total loser. All the ambiguity was gone. This breaks down that toxic psychology perfectly. Okay, step one, you know you're in a losing position. You can see it. But then, step two, the sunk costs kick in. You start thinking, but I've come this far. I've put in so much. I can't just give up now. And so you hit step three. You completely abandon rational thinking and just pin all your hopes on a miracle, a total long shot. Like Hussein thinking the US would just lose its nerve and back down. And as things get even more desperate, the logic gets even more twisted. The goalposts shift again. Now, you're not even trying to get back to even. You're just hoping for a tiny little bounce, any little piece of good news, so you can get out at a price that's just slightly less catastrophic. But of course, in a market that's just going down, that relative high just keeps getting lower and lower and lower. So after you've held on through all the red flags, trapped by your own ego and the money you've already spent, well, there's only one place that road leads. It's not a small loss, it's not breaking even, it leads straight to the crash, the absolute worst-case scenario. And this is exactly what that crash looks like in the real world. The ground war starts. His army, which was this huge source of his power, is just completely wiped out. In market terms, this is what you call a forced liquidation. He doesn't have a choice anymore. The market is taking him out of his position, and it's doing it at the most painful price you can possibly imagine. This is the sound of total, absolute capitulation. It's that last desperate scream from someone who has held on way too long. They've suffered unimaginable losses until the pain is so overwhelming they just can't take it for one more second. At this point, you're not trying to save your investment, you're just trying to stop the bleeding. Okay, so after all of that, after walking through that entire disastrous trade, from that really promising start to its absolutely devastating end, what's the one single crucial lesson that we all need to take away from this? You know, it's not some complex financial theory. It's not just for generals or CEOs. The lesson here is so simple and so fundamental that it applies to everything. Our jobs, our relationships, our side projects, anything we invest our time, our money, or our ego into. And here it is. This is the one thing you should burn into your memory. If you can't take a small loss, sooner or later you will take the mother of all losses. Having the discipline to accept a small, early defeat is the only thing that protects you from a massive, life-changing one later on. Pride, ego, the fear of admitting you're wrong, they will cost you so much more than just taking the hit and moving on.
And that really brings us to the final question, the one for you to think about. Is there a job, a project, an investment, a situation in your own life right now that you know deep down is a losing position? Are you ignoring the signals? Are you just hoping to get back to even? This story is one of the most powerful reminders that sometimes the smartest and the bravest thing you can do is just cut your losses and walk away.
You know, when we think about big money, we usually think about the stock market. But let me tell you, there's a hidden world where the real action happens, a world that makes Wall Street look small. It's a giant that never sleeps, operating 24 hours a day, just following the sun around the globe. We're talking about the world of currency trading, and at sheer scale, it's almost impossible to wrap your head around.
Take a good long look at this number. That's $1 trillion. Now, that's not for a whole week of trading. It's not even what happens on a really busy day. That is the average amount of money that changes hands in the currency markets every single day. It's this relentless, nonstop beast, just constantly moving from New York to Sydney to Tokyo to London and right back again.
So, in the grand scheme of things, all those markets we hear about on the news every night, stocks, bonds, they're just peanuts in comparison. This is the real big league, the place where fortunes are made and lost based on the tiniest little fluctuations between the world's currencies.
To even survive in this world, let alone dominate it, you need a level of dedication that honestly borders on obsession. When a journalist first went to visit our guy, Bill Lipschutz, he found market monitors literally everywhere. In the living room, sure. In the kitchen? Okay. By his bed? And get this, even a screen set up at standing height in his bathroom. This was a man who was completely and utterly plugged into the markets.
But here's the crazy part. This trading legend, the man who would one day be the head of Salomon Brothers' entire foreign exchange department, moving billions of dollars. He didn't start on Wall Street. Nope. His journey began in a place you would never, ever expect. An architecture program at Cornell University.
So on one hand, you've got his plan, right? Architecture, a respectable career with this long, methodical path. But on the other hand, you have this sudden, all-consuming fascination with the markets, and that pull was just irresistible. As he put it himself, he didn't really choose trading. Trading just took over his entire life.
The whole thing kicked off with a $12,000 inheritance from his grandmother, and he didn't just dip his toes in, he dove head first. He spent endless hours in the library, reading every financial paper he could get his hands on. He'd watch the delayed stock tape on TV for hours, just trying to develop a feel for how prices moved. And after 4 years of this intense self-taught education, he turned that initial $12,000 into $250,000.
So with that kind of success on his own, it's really no surprise that Lipschutz never practiced architecture for a single day. He went straight for the big leagues, Salomon Brothers, the most aggressive, most legendary trading firm on Wall Street. But the way he got in the door wasn't exactly typical.
I want you to picture this. You've got this college kid, probably in his first suit, sitting across from the head of the options desk, a guy named Sidney Gold. And Gold just tosses his resume aside and hits him with this line. He doesn't care about his grades. He grills Lipschutz on the real-time prices of stocks he'd been trading. And when Lipschutz just nails the answers, recalling specific price levels from years back, Gold hires him right there on the spot.
And that intense interview, that was just the beginning. It was all part of the firm's culture, this sharp, personality-driven game. And it's perfectly captured in these two little stories with the chairman himself, John Goodfront. The first time he asked about the franc, it's a test of knowledge. The second time, a year later, it's a test of memory. And it's also this incredibly dry inside joke. It just showed that even the chairman of the most powerful firm on the street was right there in the mix, watching everything.
See, that's what made Salomon so different. It wasn't some stuffy corporation. It was a culture. It was run by traders for traders. They cared more about your guts and your insights than your fancy Ivy League degree. The chairman didn't hide in a corner office. He sat right out on the trading floor, just a few feet away from Lipschutz. This was a place where it was okay to lose money as long as the idea you were betting on was smart.
But you don't become the Sultan of Currencies just by being smart. You have to go through the fire.
Lipschutz had to face these absolutely devastating losses that would break most people, testing his character to the absolute limit, both in his personal life and on the job.
So that first major trial, it came with his own personal account. After 4 years of grinding to build it up to 250 grand, he got caught on the wrong side of a big market move. He kept doubling down on his losing bets, totally convinced the market had to turn around. It didn't. In just a few days, the entire account was gone, wiped out, a totally catastrophic loss.
Look, losing your own money is one thing. The pain is just immense. But it's your pain. But what happens when you're playing with the firm's money and a trade goes catastrophically wrong? We're talking about losses piling up by tens of millions of dollars in just a few minutes.
This was the size of his position. $3 billion. He was betting against the US dollar, expecting the market to just stay quiet and calm. And then, out of absolutely nowhere, the unexpected happened. In just 8 minutes. 8 minutes! A surprise speech sent the dollar soaring in the exact opposite direction of his bet. Boom, he was instantly down $30 million. But the market in New York was totally dry. There was no one to sell his massive position to. He was completely trapped. His only shot was to somehow survive the afternoon with losses potentially spiraling toward $90 million and just pray he could find buyers when Tokyo opened for business.
So he walks over to the president of the company, Tom Strauss, and he confesses the whole massive problem. And Strauss's reaction? It tells you everything you need to know about Salomond's culture. He just calmly asks, where do we stand? And what do we want to do about this? That one word, we, in the face of a 9-figure loss, it showed that when things went bad, the firm stood together. So it was from these brutal trials, losing all his own money and then almost losing a fortune for the firm, that Lipschutz built the core philosophy that would define the rest of his career. And it wasn't about being right. It was about survival, and it was about having a structure.
Now this is his central belief, and it totally messes with your head. Most of us think that great traders must be right all the time. Lipschutz says that's just nonsense. The real key isn't how often you win, it's about how big you win when you're right. It's all about structuring your trades so that your winners are just massive compared to your losers.
So how does he actually do that? Well, his signature technique is scaling. He never ever puts his full position on all at once. He starts small. If the market starts moving his way and proves him right, then he adds to it, building into that winning position. And when it's time to get out, he doesn't just dump the whole thing. He lightens up little by little. This lets his profits run wild while he's constantly managing his risk. You know, after that early disaster where he lost everything, risk control became his religion. This checklist, it was basically his 10 commandments. Always know your exact position. Never bet the farm on just one idea. Constantly ask yourself if the risk is still worth the reward. And this last one is huge. There's no such thing as playing with the market's money. Every single dollar of profit is your capital, and you have to protect it. So, okay, we've seen the obsession, we've seen the culture that shaped him, and the trials that taught him his hardest lessons. After all those decades in the trenches, trading billions and surviving blowups, what does Bill Lipschutz think really separates the good traders from the truly legendary ones? He boils it all down to 3 things, and they're non-negotiable. First, sheer brilliance. The best traders, he says, are just operating on another intellectual level. Second, obsession. A 24/7, never switches off commitment to their craft. And finally, courage. The guts to be different, to act on what you see when no one else does, and to handle the psychological pain of being wrong.
But beyond all the smarts and the guts, what's really driving him? It's not just the money. He talks about trading like it's this incredibly fascinating, complex game that's brand new every single day. He just loves the intellectual challenge, loves keeping score, and he says, without a moment's hesitation, that if he had to, he would do it all for free.
And that really brings us to our final thought here. The dedication is just undeniable, and the success is historic. But for a passion that demands 24/7 obsession, that forces you to live and breathe those glowing numbers on a screen, you really have to wonder, what is the true personal price you pay to become a master of that universe?
All right, let's dive into a market that, on the surface, sounds incredibly complex. But the truth is, it shapes the price of everything from the gas in your car to the value of your retirement account. We're talking about the futures market, and today, we're going to break it all down for you, one simple idea at a time.
So just to give you a sense of the scale we're talking about, look at this number, $10 trillion. And get this, that's not the market value today. That was the value of futures contracts traded in the US alone, all the way back in 1991. It's an absolutely colossal figure, and it gives you a hint of the immense power flowing through this system.
Now, this is where things get really interesting, because this chart just completely shatters a common myth. When most people hear futures or commodities, they immediately think of farmers, corn, maybe some soybeans. But look at this. Agriculture, that's only about a fifth of the market. The vast majority, a full 60%, is in financial instruments. We're talking stock indexes, currencies, and interest rates.
So here's the game plan. First up, we're going to define what a futures contract actually is. Then we'll introduce you to the two main types of players, and you'll see they have completely opposite goals. After that, we'll get into the 7 big advantages that pull traders into this market, which leads us right into the most important concept of all, leverage, the ultimate double-edged sword. And finally, we'll tie it all together and show you why this massive market really matters to you.
Okay, first things first. What are we actually talking about here? The secret really is right there in the name, future. It's all about making a deal right now for something that's going to happen later.
At its very core, a futures contract is just a standardized agreement. Think of it like this. There are 3 key pieces. 1, you agree to buy or sell something. 2, you lock in the price for it today. And 3, the actual exchange happens on a specific date down the road, in the future. That's it. It's a contract about the future price of something. Simple as that.
Okay, let's use a real-world example so this really clicks. Imagine you're running a big car company. You know that 6 months from now, you're going to need a ton of copper to build your cars. So what's your biggest worry? It's that the price of copper could just skyrocket between now and then and completely wipe out your profits. So what do? You buy a copper futures contract today. Bam, you've just locked in your price for 6 months from now. And that move, that action of protecting yourself from a price swing, that's called a hedge.
So our car company, they're one side of the coin. But for every trade, there has to be another side, right? For every buyer, there's got to be a seller. And that brings us to the 2 fundamental and totally opposite types of people who make the futures world go round.
And here they are. On one side, you've got the hedger, like our car company. They are in the market to get rid of risk. They want predictability, they want stability. And on the other side, you've got the trader. They're here for the exact opposite reason. They aren't trying to avoid risk, they're actively looking for it, hoping to profit from the very price changes the hedger is trying to escape.
So you might be asking yourself, okay, why would a trader get into futures instead of just, buying stocks or bonds? Well, it all comes down to a set of really powerful built-in advantages that are unique to this particular market. Let's break down the 7 big ones.
First up, standardized contracts. This just means every contract for, say, crude oil is exactly the same, which makes trading super efficient. Second, liquidity. These markets are enormous, so there's almost always someone on the other side of your trade. Third, the ease of going short. It's just as simple to bet that a market's going down as it is to bet it's going up. And number 4, and this is the big one we'll come back to, leverage. The ability to control a huge amount of value with a very small amount of cash.
All right, next up, low transaction costs. It's way cheaper to trade one S&P 500 futures contract than it is to buy all 500 stocks in the index. Then there's the ease of offset, which is a fancy way of saying you can get out of your trade whenever you want as long as the market is open. And finally, and this is a huge one for trust in the system, every single trade is guaranteed by the exchange. You're not relying on some random person to make good on their promise. The entire exchange backs the trade.
Okay, so of all those perks we just listed, there's one we absolutely have to put under a microscope, and that's leverage. Because make no mistake, it is the biggest reason people are drawn to this market, and it's also the biggest reason they get wiped out.
So I want you to really think about this question for a second. Is it just that these markets are too wild, too unpredictable? Well, not necessarily. The answer isn't what you might think. It all comes back to the undisciplined use of leverage.
And here's exactly how it works. When you trade futures, you don't pay the whole price. You just put down a little margin deposit. We're talking maybe 5 or 10% of what the whole thing is actually worth. But here's the kicker. That little deposit lets you control the entire 100% value. It supercharges your potential profits. But, and this is crucial, it supercharges your potential losses just as much.
Now, this is a super important point, so I really want this to sink in. Margin in futures is not like a down payment on a house where you're building equity.
Nope. In futures, margin is just a good faith deposit. It's basically collateral to prove to the exchange that you can cover any losses your highly leveraged trade might rack up.
And hey, don't just take my word for it. Let's hear it straight from the source material. Leverage is a two-edged sword. The undisciplined use of leverage is the single most important reason why most traders lose money in the futures markets. See? The danger isn't necessarily the market itself. It's the power of the tool you're using.
Okay, so you might be sitting there thinking, this is all pretty interesting, but I'm just a normal investor with some stocks and bonds. Why should I care about any of this? Well, this is where we're going to connect all the dots and show you why, yes, you absolutely should care. I want you to think back to that very first chart we showed. Remember how most of this giant market is actually in financial stuff? Well, the price of, say, an S&P 500 futures contract moves almost exactly in lockstep with the actual S&P 500 index. What that means is that futures traders are basically stock, bond, and currency traders too. They're just playing in a different sandbox, a much more leveraged one.
And that brings us to a really powerful takeaway. The analysis, the commentary, the insights from these sophisticated futures traders, they are directly relevant to anybody who invests, even if you'd never touch anything besides stocks and bonds. They're looking at the exact same economic forces you are, just through a different lens. And their actions can be a huge tell for where the broader market might be heading. And that really leaves us with one final thought to chew on. You know, when you strip it all away, every single futures contract is a bet on what's going to happen tomorrow. So when you add up all those trillions of dollars, all those millions of participants, the market becomes this gigantic, collective brain, constantly making predictions. So the real question is, what is it trying to tell us about our future, right now?
Today, we're going to pull back the curtain on a true market wizard, but one you've probably never even heard of. His name is Randy McKay, and he's one of the most successful traders of the modern era, turning just a couple $1,000 into a massive fortune. But here's the thing. His story doesn't start on Wall Street. It starts in the jungles of Vietnam. And that journey, from the battlefield to the trading floor, well, that's the secret to everything. So let's get into it.
And boom, right there. That quote is the key to this whole story. This isn't really about complicated charts or secret formulas. It's about a complete rewiring of a person's brain. For McKay, learning to stop following orders and start trusting his own gut, that was the single greatest trade he ever made.
All right, so here's our game plan. We're going to break down his unbelievable story in 5 parts. First, how he basically stumbled into trading by pure accident. Second, how the Vietnam War completely changed him. Then, we'll look at his first monster payday, how he survived some truly catastrophic losses, and finally, we'll boil it all down to the core trading rules he lived by. Okay, so let's kick things off with part 1, the accidental trader. You know, when you think of a legendary trader, you probably picture some kind of math genius who was obsessed with markets from childhood, right? Well, for Randy McKay, it was pretty much the exact opposite.
No joke. This is how it started. In college, McKay got completely and totally hooked on playing the card game bridge. I mean, he was playing day and night, never went to class, and ended up flunking out with 6 Fs. And because this was 1968, what happens when you flunk out of college? You get a draft notice. So he wasn't chasing some dream of financial glory. He was a kid who played too many cards and got shipped off to the Marines.
So even after he came back from the war, trading wasn't on his radar at all. He actually wanted to be a clinical psychologist. The only reason he ever stepped onto a trading floor was because his brother, who was a broker, got him a job as a runner. It's like the lowest job on the totem pole, just running paper orders back and forth. And why did he take it? Because the morning hours let him take his psychology classes in the afternoon. He spent 2 years there with absolutely zero plans to stick with it.
But to really understand the trader he became, we have to go back to the single most important experience of his life, his time in Vietnam. This is where the old Randy McKay, the rule follower, disappeared, and a new, independent thinker was born.
Before all this, McKay was, in his own words, a conservative kid, a model citizen, you know? He believed that if you enjoyed the privileges of living in the country, you had to accept the responsibilities. He thought the war seemed kind of stupid, sure, but his mindset was, hey, the elected leaders made the call, so my job is to follow orders.
But then he got there, and the brutal reality of combat just shattered that entire worldview. He talked about realizing that the enemy he was supposed to be fighting was just another scared kid, just like him, also just doing what he was told. And that clicked something in his head.
The idea that powerful people would send kids to kill each other over a piece of dirt. It convinced him that the entire system he'd been taught to trust was just, well, irrational.
And this was the moment everything flipped. I mean, look at this. It's like two different people. He went from being a rule follower who trusts the system to an independent thinker who questions authority and, most importantly, learns to trust his own judgment. That newfound skepticism would become his greatest weapon as a trader.
So, Section 3, the big score. Let's see how this radical new way of thinking actually translated into making money. McKay's brother loaned him the money for a trading seat, and this independent mindset was immediately put to the test.
And wow, the results were immediate. He started with just $2,000. In 7 months, he turned it into 70 grand. And you have to understand, the currency markets back then were so slow, so boring, traders were literally playing board games in the pit to pass the time. Yet here comes McKay, and he's just killing it.
But the trade that made him a legend came in 1976. The British government publicly announced they would not let the pound trade above $1.72. So what did everybody else do? They sold. They saw it as a risk-free bet. But Mackay, the guy who learned not to trust authority, saw something different. He thought, wait a second, if the government has to come out and say that, it must mean there's incredible buying pressure they're trying to hold back. So while the entire floor was selling, he went long and he went big with a massive 200 contract position. And of course, the market blew right past that government line and just exploded higher.
And the payoff for that one single contrarian trade? $1.3 million. That was it. That was the ultimate proof of his new philosophy. Don't just follow the crowd. Think for yourself. That single trade launched him into a whole other league.
But of course, being a great trader isn't just about the wins, right? It's about how you survive the hits. So, Section 4, Surviving Catastrophe. McKay had some absolute disasters that taught him his most painful and valuable lessons about risk.
You know, one of his most agonizing experiences wasn't even losing money, at least not at first. In 1979, gold went on one of the biggest bull runs in history, and he missed it. He was on the sidelines. He said the anxiety, the FOMO, of watching that rocket ship leave without him was pure torture. He finally cracked and bought in, on the exact day of the market top, and got wiped out. The lesson? The psychological pain of missing out can be even more dangerous than being in a losing trade.
But his single worst financial loss was a real gut punch. $7 million. And the story of how it happened is a masterclass in what not to do, because it was just a domino effect of bad decisions that violated every rule he would later create. So here's the play-by-play. He was long the Canadian dollar, and he was up big, about $2 million. Then this political debate completely flips the election polls overnight. The market tanks. He sees the huge drop on his screen but just dismisses it thinking, it's probably a quote error. And then he gets on a plane for a vacation in Jamaica where he had no phone. By the time he could finally get to a phone and get out, his $2 million profit had turned into a $7 million loss. Just an absolute train wreck.
And that disaster burned this rule into his soul forever. His philosophy became simple. The minute you get hurt, the minute a trade goes badly against you, your brain short-circuits. You start making emotional, irrational decisions. So you don't think, you don't hope, you don't wait for it to come back. You just get the hell out.
Okay, on to our final section. Section 5, McCall's Rules for Trading. So after decades of these incredible highs and devastating lows, what are the core principles that guided him? Let's boil it all down.
All right, so first, we've already hammered this one home. Get out of your losses fast. But look at these others. He says don't try to be a hero, picking the absolute top or bottom. Just try to catch the easy part in the middle. He also says the news itself is worthless. What matters is how the market reacts to the news. But his most unique rule, the one that really sets him apart, is all about position sizing.
Mackay basically treated his own trading performance like a market trend. When he was hot, when he was in the zone, seeing things clearly and making money, he would trade very, very large. He'd press his bets. But the second he hit a losing streak, the second he felt himself wishing and hoping, he would shrink his size down to almost nothing. He'd go from trading thousands of contracts down to 10 until he got his groove back.
But at the end of the day, McKay says the single most important key to long-term success is this: finding a trading style that is in perfect harmony with your personality. You can't be a cautious, risk-averse person trying to be a gunslinging day trader.
It creates this internal battle that he says you will always lose. And really, McKay himself is the ultimate example of this. He had these two conflicting sides of his personality. He took the risk-taker, the independent thinker that was forged in Vietnam, and he put that guy in charge of finding the big contrarian trades. But he took the conservative, rule-following kid he used to be, and he put that guy in charge of his money management. He blended his two sides perfectly.
So we'll end with the question I think you'd want all of us to ask ourselves. And this goes way beyond trading. In your career, in your life, is the strategy you're using in sync with who you really are? Are you fighting against your own nature every single day? For Randy McKay, figuring that out, finding that harmony, that was the difference between blowing up and becoming a legend.
Today, we're diving into the mind of a trading legend you've probably never even heard of, William Eckhardt. Now, this is a guy who was right at the center of one of the most famous financial experiments in history, but somehow he's like a ghost in the story. So how can someone be so important and yet so invisible? Well, let's find out. This one quote right here is the key to everything. Eckhardt, who is partners with the absolute legend Richard Dennis, made a bet that sent shockwave through the financial world. And it was a bet he was 100% sure he was going to win. So you gotta ask, what was this bet that became such a legend?
All right, to really get Eckhardt's whole philosophy, we've got to go back to the very beginning, to this famous bet. And look, this wasn't just some casual wager. This was a clash of titans, a battle of ideas that kicked off one of the most incredible experiments in trading history.
I mean, you gotta love this guy's journey. He wasn't your typical finance bro. He was a PhD candidate in mathematical logic, of all things. Then in 1974, he decides to take a quote-unquote sabbatical to try trading and just never went back. And his success? Absolutely staggering. We're talking averaging over 60% a year. That's the kind of record that sets you up for a pretty high-stakes bet with your best friend.
In this, right here, this is the core of it all. It was the classic nature versus nurture debate, but for Wall Street. You see, Richard Dennis was convinced that great traders could be made, that you could teach it. Eckhardt, the math guy, said no way. He argued great traders are just born different, with some kind of gut instinct you just can't teach. So how do you settle an argument like that? Well, you run an experiment. So they went out, they recruited a bunch of total novices who they nicknamed the Turtles, taught them a specific set of trading rules, and guess what? The result was a massive, undeniable success. The guy who bet it couldn't be done was proven completely wrong. And to his credit, Eckhart stood up and said, "Yep, I was wrong." But for him, that wasn't the end. It was actually the beginning. Losing that bet made him dig way, way deeper into what really separates the winners from the losers.
And that leads us right into Eckhardt's real genius, thinking in probabilities. Losing that bet was the best thing that could have happened to him. It forced him to sharpen his mathematical pencils, to look past the simple rules, and really start questioning everything about price, risk, and the very nature of probability itself.
And it all kicks off with this really fundamental question. You know, most of modern finance is built on this cozy little idea that market prices are normal, that they fit on a nice, clean, predictable bell curve. But Eckhardt, being Eckhardt, looked at the messy real world and asked a simple but totally dangerous question. Do they, though? Do markets actually work that way?
And his answer was a hard no. He said that price distributions aren't just a little off, they're, in his own words, pathological. They're wild, they're unpredictable, they don't fit our neat little models. I mean, look at the 1987 crash. That was a once-in-a-billion-years event, according to the math. But it happened just a few years after the S&P contract started trading. That's not normal, that's pathological.
So if the fancy, delicate tools of statistics break when you show them real markets, what's the solution? Well, Eckhardt was a big fan of something called robust statistics. And the analogy here is just perfect. You don't bring a scalpel to a bar fight, right? You need a blunt instrument like a hammer. It's a method that's designed to knock it thrown off by crazy, unexpected data, which is exactly the kind of stuff markets serve up every single day. Now, this deep skepticism leads us to our next stop. And this one might sting a bit for some of you. We're going to talk about why your charts lie. Eckhardt basically took one of the most sacred tools for traders, the price chart, and argued that what most of us think we see there is not only wrong, it's actually dangerously misleading. And this quote just nails the problem. Our brains are absolute pattern-finding machines. It's what we do. It's why you see faces in the clouds or animals in wood grain. And when we look at a random price chart, our brain goes into overdrive, seeing all these head and shoulders and double bottoms. But Eckhardt's warning is that most of the time, we're just seeing ghosts in the machine.
So based on his own hardcore testing, Eckhart basically throws a whole bunch of super popular trading tools right in the trash. He calls them bogus. I mean, we're talking about things like RSI and stochastics, indicators that thousands of people swear by. He says, sure, they might make you feel good when the market's quiet, but when a real powerful trend comes along, they get absolutely annihilated. Their profit expectancy is basically zero.
And he has this devastatingly simple way to prove why things like Gann angles, which are all about the geometry on a chart, are total nonsense. He calls it the invariance test. Now think about this for a second. The angle of a trend line on your screen, it isn't a real thing. It's just an illusion created by how you've scaled your chart. If you squish the chart, that steep trend becomes flat. If you stretch it, it becomes a rocket ship. That proves the angle has no real meaning at all. It's completely arbitrary.
Okay, so if our tools are garbage and our brains are seeing patterns that aren't there, what's left? Well, this brings us to Eckhart's biggest and most powerful idea. The single greatest obstacle between you and making money isn't the market, it's your own mind. Your brain is your enemy.
And this slide just lays out the war going on inside every trader. Everything that feels good, every natural human instinct you have, is almost the exact opposite of what you need to do to make money. It feels so good to grab a quick, small profit, right? And it feels horrible to admit you're wrong and take a loss. But the golden rule of trading is to cut your losses short and let your winners run, and that feels completely unnatural and awful.
And here we go again. Eckhart takes one of the oldest sayings in trading and just blows it up. We've all heard it. You can't go broke taking profits. Sounds smart, right? Safe? Eckhart says it's not just wrong, it's deadly. In fact, he says that's precisely how a ton of traders go broke. Why? Because you get addicted to banking these tiny little wins, and all it takes is 1 or 2 big losses to wipe out weeks of work.
Let's just sit with this for a second, because it's so important. Amateurs blow up their accounts with 1 or 2 huge catastrophic losses. They just refuse to get out. But professionals, they know how to control risk. So how do they go broke? It's much quieter. They bleed to death from 1,000 paper cuts. They keep taking those small, feel-good profits, and they never, ever let a trade run far enough to get those massive home run wins that actually make the whole system profitable.
So if trading is this constant bloody battle against our own brains, what is a trader's job supposed to be? Well, according to Eckhart, it's not about being a genius predictor or having some magic intuition. Your job is to be a cold, disciplined researcher and a ruthless, unemotional executor.
And it all starts with this one simple, non-negotiable number, 2%. Eckhart is crystal clear. You should never, ever plan to risk more than 2% of your account on any one trade, period. See, this isn't about making money. This is about staying in the game. It's about survival. And in this game, survival isn't just the main thing, it's the only thing.
And here's the roadmap. It's basically the scientific method for markets. First, you come up with an idea. But then, and this is the most important part, you do everything you can to prove your own idea is garbage. You try to falsify it. This is so hard, because all we want is to be right. But you have to attack your own ideas mercilessly. And only if an idea survives that brutal assault do you build a system around it. And once it's built, you follow it like a robot. No exceptions.
Man, here's another one of those classic Eckhart mind benders. We are wired to run away from pain. But he says in trading, pain is your friend. It's essential. If you don't actually feel the sting when you lose money, you're like a person who can't feel fire. You're going to get horribly burned and not even know it. This is why he says it's actually better to trade with a small amount of money you genuinely cannot afford to lose than with a huge account that you don't really care about.
And this, right here, this is really the whole thing in a nutshell. It's Eckhart's entire philosophy. Your feelings are basically a reverse indicator. That trade that feels safe, easy, comfortable, it's probably the wrong one. He even told his students, look, if you're ever on the fence and all the signals are balanced, just do the thing you want to do the least.
We're going to end with what might be Eckhart's most chilling idea. It's a known fact that most traders lose money. They actually do worse than if they just flipped a coin. Why is that? Well, he suggests it's because the market isn't just random. The market is a tutor. But it's a tutor that is actively, systematically trying to teach you how to lose. It gives you a little cookie for the bad habit of taking small profits. It encourages you to hold on to your losers. It makes you feel safe right before it pulls the rug out from under you. And that leaves us with one final terrifying question. When you step into the market, are you just playing a game of chance, or are you stepping into the ring with an opponent that is specifically designed to exploit your deepest human flaws?
Welcome to The Explainer. Today we're going to dive into this incredible, real-life experiment that tried to answer a timeless question. Are great traders just born with some kind of magic touch, or can they actually be made? So picture this. Two super wealthy traders are going at it. One guy is absolutely certain that trading is a skill, right? A set of rules that anyone can learn. But the other guy? He thinks that's total nonsense. He's convinced it's a rare, natural talent you're either born with or you're not. And this wasn't just some friendly debate over drinks. Now, while that little scene might be from a story, it perfectly captures a very real, very high-stakes argument between two legendary Chicago traders. And this was a debate that didn't just end with words. Oh no, it sparked one of the most audacious experiments in the history of finance. Okay, so let's get into it. This is where a philosophical argument turned into a massive, real-world experiment with millions and millions of dollars on the line. So on one side, you have Richard Dennis. This guy was a trading legend who supposedly turned just a few $1,000 into a mind-boggling $200 million. He was adamant he could teach anyone to be a great trader. And on the other side, you've got his partner, William Eckhardt, another brilliant trader, who basically thought Dennis was nuts. He said it was all about rare, unteachable talent. So to settle this thing once and for all, Dennis launched what became one of the most famous experiments in financial history. He wasn't just going to argue his point. He was going to prove it by literally creating elite traders from scratch. They actually put an ad in the Wall Street Journal, and you know what? They were flooded with over 1,000 applications. They set up this super tough process with exams and interviews to whittle that list all the way down to just 13 people for the first group. And what's really wild is that they weren't looking for experienced traders. In fact, about a third of the people they picked had zero experience in the markets. None. And get this, the people they chose were from all over the place. I mean, we're talking about a creative manager from the company that made Dungeons & Dragons, a consultant with a degree from MIT, and even a high school student. It just proves they weren't looking for a specific resume. They were looking for a certain kind of mindset. So why the weird name? The Turtles? Well, the story goes that Dennis was on a trip and visited a turtle farm, and it just clicked. He said, "We're going to grow traders just like they grow turtles." And somehow the name stuck. So he trained this group for 2 intense weeks, gave them his exact secret trading rules, and then, get this, funded their accounts with his own money. Talk about putting your money where your mouth is. So the experiment is a go. The turtles are out there in the markets, trading with Dennis's money and his secret system. But the big question was still hanging in the air. Did it actually work? Was Dennis about to win this bet? I mean, the whole argument, the whole bet, the whole experiment, it all came down to the performance of this hand-picked group of total novices. So did they prove him right? The results of this whole crazy experiment? Well, it can pretty much be summed up with a single powerful number: 44%. The results were, and I'm not exaggerating here, absolutely staggering. 6 years later, when the author of our source material did a survey of over 100 of the world's best professional traders, he found that almost half, 44%, of the absolute best of the best came from this one tiny little experiment. Richard Dennis hadn't just proven his point, he had shattered expectations. Okay, so with that kind of incredible, undeniable success, the next logical question on everyone's mind was, how? What was this secret system they were taught? Well, finding that out turned out to be nearly impossible. Yeah, the author basically hit a brick wall, and fast. Turns out the turtles had all signed these ironclad non-disclosure agreements, and they were taking them very seriously. Even when they were promised their secrets would be safe, most of them either flat out refused to talk or were just incredibly tight-lipped. So for example, the author would ask the most basic, fundamental question you could ask a trader. And the answer he'd get back was something like this: "I basically use the system, but I can't say much more than that. Super helpful, right?" This was the beginning of this pattern, a total wall of silence built to protect the system that had made them all so successful. All right, so the author tried a different angle. He said, okay, forget the specifics. Just conceptually, how does your system think differently than other strategies out there? Surely they could talk about that, right? Nope. The answer was just a shutdown.
They remained completely guarded, shutting down any question that got even close to their training. The secrets of the system? They were staying firmly locked inside the shell. But here's the thing. Even without the secret formula, the interviews with a few turtles who did open up a little bit revealed some really powerful principles. Not about what to trade, but about how to think. And these are lessons that apply to pretty much anyone in any field. So Turtle Michael Carr, the Dungeons and Dragons guy, shared this absolute gem. It's a huge shift in focus. He's saying, stop trying to predict the future, because you can't. Instead, build a rock-solid plan for how you're going to react no matter what happens. It's all about controlling what you can actually control, your own actions. Then there was another turtle, Howard Seiler, who offered 3 huge principles. First, have a plan. This forces discipline and lets you measure your performance, not just your profit. Second, be persistent. Every good system has losing streaks. You have to have the guts to stick with it. And third, and this one is so important, understand the difference between respecting risk and fearing it. Respecting risk is smart. Fearing it just makes you make bad emotional decisions. And Seiler learned that last lesson the really hard way, back when he was a teenager. He saved up $1,000 from doing chores, correctly predicted a crash in the potato market, but he got scared and pulled out way too early. Just 2 days later, the market crashed just like he thought it would. He missed out on a huge win because his position was so big it made him fearful. He actually called that loss fortunate because it taught him a priceless lesson. You cannot make good decisions when you are terrified. So the ultimate message from this whole turtle experiment is just incredibly powerful. It proves that Richard Dennis was right all along. Success isn't some magic you're born with. It's a process. If you have the right set of rules, the discipline to actually follow them, and a system to guide you, you can achieve exceptional things in almost any complex field. And that leaves us with one final big question for you to think about. If greatness isn't just born, but can be systematically taught and created, what does that mean for our own potential? If someone could hand you the perfect, foolproof system for mastering any one skill, what would you choose? Thanks for joining us for this deep dive into the incredible story of the turtles. Have you ever heard about a trader whose returns just seem impossible, like so good they almost defy logic, but all while taking surprisingly little risk? Well, today we're going to get inside the head of one of those traders, Monroe Trout. His performance was so incredible, it was almost mystifying. Trout didn't see himself as some kind of Wall Street cowboy or a gambler. Not at all. He looked at his work with this incredible clarity. He was a businessman, and his business was basically manufacturing profit. This quote just nails his no-nonsense, get-it-done approach to the markets. Okay, let's talk numbers, because they're just wild. Over a 5-year stretch, Trout's average annual return was a staggering 67%. I mean, think about that for a second. That's a level of performance that most of the trading legends out there could only dream of. But honestly, that's not even the most amazing part of his story. Right, here it is. This is where you see the real genius at play. While he was pulling in those massive returns, his largest drawdown, the biggest dip from a high point, was just over 8%. This mix of sky-high returns with ridiculously low risk is what made him legendary. It was, quite literally, the best return that low risk could possibly buy. So that brings us to the million-dollar question, right? How on earth did he do it? Was it some secret black box system, a rare natural talent, or something else completely? Well, in this explainer, we're going to pull back the curtain and unpack the key pillars of Monroe Trout's strategy, from his early academic work to the tough lessons he learned on the trading floor. Look, Trout's success was no accident. It wasn't luck. It was built brick by brick on a foundation of intense focus and a really deep understanding of how markets actually work, an understanding he started building when he was just a teenager. Let's take a look at how this mind was really forged for trading. I mean, his career path was just a straight line. It all started with this grunt work, just typing data into an old Apple computer, but that's what lit the spark. Then at Harvard, he just zeroed in on the markets. His whole focus was there, which led to this senior thesis where he found something huge. And then, he completely skipped grad school, he knew exactly what he wanted to do, and that was trade. So he went right into the belly of the beast in New York. So what was this big discovery in his thesis? It was this idea of fat tail risk. Basically, he realized the market doesn't always play by the rules of a nice, clean bell curve. The chance of a massive, out-of-nowhere price swing, a fat tail event, is way, way higher than most of the standard models predict. This one single insight shaped his entire career. It's why he was so obsessed with using less leverage, less borrowed money, and always putting risk control first. So, after college, Trout gets on the trading floor and starts learning things you could never, ever find in a textbook. Let's dive into some of the, let's call them unconventional strategies he picked up that gave him a serious advantage. One of the very first things he noticed was a pattern in how people behave. Amateur traders, trying to protect themselves, they always put their stop-loss orders in the same super obvious spots. And this predictability, well, it created a massive opportunity for the pros on the floor, the locals, to take advantage of. And these points were just incredibly predictable. You'd see all these stop orders clustered right above the last day's high, or just below the last day's low. And they'd always pile up around big, psychologically important round numbers, like Dow 3000. For the floor brokers, these spots were like a giant flashing sign. This whole thing led to what Trout called the magnet effect. He saw that markets are almost magnetically drawn to these big, round numbers. So his play wasn't to trade after it broke through, it was to get in before that level was hit. So, say, he'd start buying when the Dow was at 2,950 and then just ride that wave of momentum as the market got pulled towards that 3,000 magnet. Another key lesson he learned from the floor was just understanding the daily rhythm of the market. Trading volume almost always makes this U-shape. A ton of action at the open, then it gets really quiet midday, and then another big rush at the close. Trout used this to his advantage, especially during that quiet midday lull, where he could put in small orders to defend his positions for a really low cost. So, we've talked about his market insights, which are brilliant. But here's the secret weapon that people often miss. It wasn't just what he traded, it was how he traded. His absolute obsession with minimizing every single cost was a total game changer. This just shows you the power of good execution perfectly. Okay, imagine a trading system that on average makes just $40 a trade. For most traders, once you factor in commissions and slippage, that little difference between the price you want and the price you actually get, that system is a money loser. But for Trout, because he was doing so much volume and was always pushing his brokers for better rates, his costs were so tiny that the exact same system became a consistent winner. So just how big of a deal was this? Trout himself estimated that his better execution, saving on slippage and getting rock-bottom commissions, added a full 12% to his annual return. This wasn't just a small edge, it was a core engine driving his profits. Look, having an edge is one thing, but surviving long enough to actually use it is something else entirely. Trout knew that a catastrophic loss is always just around the corner. Let's look at a pretty dramatic real-world event that literally forged his unbreakable rules for survival. The date was January 9th, 1991. The U.S. Secretary of State, James Baker, was meeting with the Iraqi ambassador, and the markets were feeling pretty optimistic about it. Then Baker walks up to the podium and starts his statement with one single ominous word: regrettably. For traders like Trout, who was holding a huge long position, there was zero time to react. The floor just evaporated, the bids vanished. As he put it, the damage was done almost instantly. I mean, the speed of that loss was just breathtaking. So what was the final tally on that one day? About $9.5 million. That's an amount that would absolutely destroy most traders, not just financially, but emotionally. But this is exactly the kind of fat tail event that his entire philosophy was built to survive. And this is how he did it. These rules are basically his Harvard thesis on fat tail risk put into practice. He lived by a set of rigid, totally non-negotiable limits. A max loss on any one trade. A max loss for the whole day, which would trigger him to just liquidate everything. A max loss for the month. And he'd decide on his position sizes ahead of time and never, ever go over them. These weren't just guidelines. They were the law. And they guaranteed he would always live to trade another day. So was Monroe Trout just a pure numbers guy, a quant, who just let his computers do all the work? Or was he more of a gut feel discretionary trader? Well, the answer, and really the key to his incredible performance, is that he was both. By his own account, his whole approach was a 50-50 split. Half of his decisions came from dozens of different computer models, all based on statistics. But the other half? That was pure discretion. It was his feel for the market, listening to the noise level on the floor, his uncanny ability to time his entries and exits perfectly. He actually believed that this human element,
doubled the returns of his systems.
Okay, let's bring this all home. If you boil down Trout's entire philosophy, it comes down to these 4 core ideas. First, and most importantly, you have to have a real, verifiable edge. Second, you absolutely must pair that edge with rigid, unbreakable risk control. And these 2 things are totally dependent on each other. You see, great money management can't turn a bad idea into a good one, but even the best trading idea in the world will eventually get destroyed by bad money management.
You know, Trout's whole career was basically one big argument against the efficient market theory. He found patterns where they weren't supposed to exist, he exploited inefficiencies, and he built a fortune by questioning what the economics said was true. And that really leaves us with one final thought. If a fundamental idea like the efficient market theory could be proven wrong, what other pieces of conventional wisdom in finance and business, maybe even in our own lives, are just sitting there waiting for someone to come along and challenge them?
All right, let's get right into it. Today, we're talking about one of the most successful and honestly one of the most secretive traders out there, Al Weiss. They called him the human chart encyclopedia, and we're about to find out exactly why.
So to get a sense of just how good this guy was, look at this number, 52%. That was his average annual return for almost a decade straight, from 1982 to 1991. I mean, think about that. If you'd put just $1,000 with him in '82, you'd have walked away with almost 53 grand by 1991. The numbers are just absolutely insane.
But here's the part that's really going to blow your mind. He got those incredible returns with this number, less than 5%. That was his average yearly drawdown, the drop from a peak, between 88 and 91. So he's making massive, massive gains while taking on almost no risk. That right there, that's the holy grail in trading, and it's the big mystery we're going to unpack.
So you gotta ask, right? If he was so incredible, why haven't most of us heard of him? Well, for over a decade, Weiss just flat out refused to give any interviews. He was a super private guy. Even admitted he'd only met like 5 of his clients in 10 years. He just didn't feel like his methods were truly proven until he had a solid decade of performance under his belt.
Now, the really cool thing here is that his success wasn't just some lucky break. No, it was built on this almost unbelievable amount of quiet, focused prep work. So let's see how he got a start.
Weiss said it himself, 4 full years. Just imagine that, thousands of hours staring at charts before he even thought about placing a serious trade. This is the exact opposite of that classic risk-loving trader image, right? He calls himself risk-averse, and that's what pushed him to build this bulletproof system before he ever put real money on the line.
And you might be wondering, how did he even afford to do that? Well, he wasn't born rich. In his early 20s, he was actually an entrepreneur. He pioneered the urethane skateboard wheel. Wild, right? That was a huge success. He then took those profits, smartly invested in real estate, and bam, he was financially independent. That freedom is what let him treat market research like a 9-to-5 job without any pressure to make a quick buck.
Okay, so he had the time, he had the money, he had the mindset. But what did he actually find during those 4 years of deep diving? Let's decode his method. This chart just lays it out perfectly. On the right, you've got your standard technical trading. You're maybe looking at 30 years of data, you're spotting individual patterns, but then on the left, you've got Weiss. This guy went back to the 1840s. He wasn't just seeing a pattern, he was seeing how that pattern acted inside these huge, long-term economic cycles. He was looking for these complex combinations, patterns within pattern. So let's break this down into his 3 pillars. First, historical depth. Going back 150 years gave him this insane mental library of how markets act. Second, economic context. He figured out that the exact same chart pattern can mean 2 totally different things depending on whether you're in an inflationary or deflationary period. And finally, pattern complexity. You see, a simple pattern isn't enough. For Weiss, a real signal was a pattern within a pattern. It's that layering that let him find only the absolute highest probability trades. But underneath all the charts and all the data, there was this really simple, powerful belief about what markets really are. And this kind of gets to the heart of his whole philosophy.
This quote, it just says it all. Weiss believed that things like a company's earnings or a commodity's true value, they could be totally irrelevant for long stretches of time. What really mattered was human psychology, fear, greed, panic, euphoria. To him, a chart wasn't just a bunch of lines, it was a picture of human emotion. And man, he learned to read that picture better than anybody.
Okay, let me give you a perfect example of this in action. Picture this. It's the summer of 1990.
Weiss is on vacation in the Bahamas. But of course, he's still charting the markets every single day.
So he's sitting there, literally at a picnic table, and suddenly his system starts flashing these powerful buy signals all across the energy markets. Crude oil, heating oil, the whole shebang.
Now you gotta understand how weird this is. Getting a strong buy signal for heating oil in the middle of summer? That's just completely backwards. Demand is at its lowest point of the year. But Weiss didn't even blink. He trusted the patterns of human behavior that his system was built on, and he called in the trades.
And the payoff was just boom, immediate. 3 days after his system flagged the trade, Iraq invaded Kuwait, and the energy markets went absolutely parabolic. See, his charts didn't predict the news, but they predicted the psychology, the market setup that would cause such a massive reaction to the news.
All right, here's another great story that shows a totally different side of his skill. It's not just about following the system. It's about knowing when your own gut, your own intuition, can make it even better. This one takes place during the legendary stock market crash of 1987.
So while his clients are calling him, totally freaking out, Weiss is just calm. His system is doing fine. But he had this intuitive read. He could feel the sheer terror in the market, and he knew what panicked investors always do. They run for safety. And the ultimate safe asset is U.S. Treasury bills. So in a super rare move, he overrode his own system. Even though it hadn't spit out a signal, he manually got out of his short position in T-bills, which was basically a bet their price would fall. And he was dead right. Almost instantly, T-bills shot up as all that panicked money flooded in. This just shows it wasn't a robot, it was a true master at work.
And all of this brings us to that huge question that every single trader asks at some point. Is what Weiss does an art, based on intuition and feel? Or is it a science, based on hard, repeatable rules?
Well, Weiss's answer is just brilliant. He says it's both. The process of seeing and interpreting these patterns across 150 years of data, that's the art. But then, and this is the key part, you take that artistic vision and you lock it down with precise mathematical rules. You turn it into a system, and that's the science.
So after digging into the man, his mindset, and his method, what can we actually take away from all this? What's the blueprint? Let's boil it all down to the core principles.
Here it is, the Weiss blueprint. Number 1, go deeper. Don't just look at 30 years of history. Look at 100 or more. 2, understand the context. Is the world inflating or deflating? Because it changes everything. 3, see the combinations. The best trades come when multiple patterns all point in the same direction. And finally, number 4, the big one. Never, ever forget that what you're really charting is human psychology.
And we'll end on this amazing kind of self-aware quote from the writer who interviewed him. He basically says, sure, you can be successful too. All you have to do is read a chart with the exact same skill as Al Weiss. Then he adds, not very helpful information, is it? And that just perfectly captures that huge, intimidating gap between knowing something and truly mastering it. It really makes you wonder.
All right, today we're going to talk about a true market legend, Stanley Druckenmiller. You know, he's one of the most successful investors of all time, and his story is just packed with these incredible lessons. Lessons on making huge decisions, learning from epic failures, and building that unshakable conviction. So let's get into it. So what's with this number, 37%? Well, that was Stanley Druckenmiller's average annual return for his own fund, Duquesne Capital. And that's from the very beginning in 1980 until he closed it off. Now, to wrap your head around that, getting that kind of return for just 1 year is incredible. To do it for decades, it's almost unheard of. And here's the really wild part. For a big chunk of that time, he wasn't just running his own fund. Oh no, he was also steering the ship at the legendary Quantum Fund for his idol George Soros. We're talking billions and billions of dollars, and he was still pulling in returns that were just completely off the charts. The scale and the consistency, that's why we have to understand how he thinks.
Now, Druckenmiller's story. It doesn't start on Wall Street like you'd expect. Nah, it begins in a much more unlikely place, Pittsburgh National Bank. And it's here that his biggest weakness, his total inexperience, actually turned out to be his greatest strength.
You gotta hear this. When his boss, a guy named Spiro Strelis, promoted a 25-year-old Druckenmiller to Director of Equity Research, this is what he told him. I mean, what a raw, powerful thing to say. It's all about the value of having this fearless, unscarred view of the markets.
I mean, just picture it. In less than a year, he literally leapfrogs his own 50-year-old boss and a whole department full of analysts with fancy MBAs. His boss, Dorellis, he saw that the senior guys were just stale. They were scarred by a bear market. He didn't want experience. He wanted someone who was, in his words, too stupid to know not to try to buy everything. He wanted a charger.
Okay, this question right here. This was probably the single most important question of his entire early career. He just handed in this really thorough academic-style paper on the banking industry, probably super proud of it. And his boss just reads it, tosses it aside, and asks him this. He didn't care about all the fundamentals, he just wanted to know the one thing that actually moves the needle.
And that question just totally flipped his thinking on its head. He learned that, okay, for bank stocks, it's all about earnings. Simple enough. But for chemical stocks, it had nothing to do with earnings. It was all about industry capacity. The time to buy wasn't when things looked good, but when capacity was leaving the industry right before demand picked up. It was a huge lesson. Every industry, every stock has its own unique driver, and your job is to find that one thing.
So, armed with this new laser focus, he leaves the bank and starts his own firm, Duquesne Capital. But his early years, well, they were not some overnight success story. Not at all. They were actually defined by a series of really painful failures that would end up forging that super flexible, go-anywhere style that made him a legend. Just look at this timeline of disasters. He starts his firm, and boom, almost immediately, things go sideways. He was right about the market being bearish, but he still lost money because he was partially invested. Then, poof, his main source of income just vanishes overnight. His firm is suddenly in a really, really desperate spot. You can just feel the sheer panic in this quote, right? His main client goes bust, and suddenly he's looking at a massive $110,000 hole in his tiny firm's budget for the year. He had a negative net worth and was just scrambling to survive.
And in that desperate moment, he made a classic mistake. He was so sure, so absolutely convinced he was right about interest rates. So what does he do? He takes all the firm's money, about 50 grand, and levers it up in T-bill futures. And he didn't just get it wrong, he got wiped out. 4 days, it was all gone. And the real kicker, less than a week later, interest rates peaked and started that long slide down he had predicted. Ouch.
And that was the lesson, forged in fire. Being right about the market's direction just isn't enough. The market is a tough teacher, and it does not care about your needs. His desperation to win basically poisoned the whole trade.
But you know what? That failure was actually a gift. It completely shattered that old banker mentality that you always have to be invested in something. He learned that if your analysis says things look bad, the right move is to just go to cash, or even better, bet against the market and go short. That flexibility became the absolute cornerstone of his entire strategy.
All right, now we get to one of the most famous stories in trading history. We're talking about Druckenmiller and the 1987 Black Monday crash. This was the single biggest mistake of his career, and it was followed by his single most impressive recovery.
Okay, check out this sequence of events, because it's wild. Back in June, he correctly sees a bubble forming. He looks at valuations, sees the Fed tightening, it all points down. So he goes short, but he has to fight the market for 2 months as it just keeps climbing. Then, on Friday, October 16th, he gets convinced the market's going to bounce, so he flips his entire position, going from short to 130% long. He was leveraged to the moon on the eve of the biggest crash in modern history.
So that Friday night, everything changed. Soros shows him a study from another legend, Paul Tudor Jones, and it showed this terrifyingly similar pattern between the 1987 market and the 1929 crash. And in that moment, it just confirmed his worst fears. He knew, with total certainty, that he had made a catastrophic mistake.
And this, right here, is what separates the legends from everybody else. On Black Monday, as the market is just in total free fall, he doesn't freeze, he doesn't hope, he doesn't pray, he acts. He sells every single thing he owns during a tiny bounce in the first hour, then immediately flips and goes short. And unbelievably, he finished the month of October with a net gain. He proved that the ability to just admit you're wrong instantly, no ego, is the ultimate survival tool.
So after proving himself like that, Druckenmiller decides to go work for his idol, George Soros. He felt like he needed the last chapter of his education, and he knew Soros was the one who could teach him. And this is where he learned his most important lesson of all, how to be a pig.
This story is just classic. The Berlin Wall had just fallen, and Druckenmiller had massive conviction that the Deutschmark was going to soar. He puts on this huge $1 billion position, feeling pretty good about himself. But when he tells Soros, Soros just kind of scoffs at him and tells him to double it. Druckenmiller did, and, well, the trade went dramatically further in their favor.
And this gets to the absolute core of the Soros philosophy. It's not about being right or wrong, it's about how much you make when you're right versus how much you lose when you're wrong. When you've done the work, when your analysis is crystal clear and the market gives you that fat pitch, you can't be timid. You have to go for the jugular.
So, after all these experiences, the early flameouts, the '87 crash, the masterclass from Soros, what does the final playbook actually look like? Let's try and boil it all down into a clear set of rules.
Here it is. Number 1, preserve capital. That's job 1. You got to stay in the game. Second, go for home runs. When you're having a great year, you don't get timid. You press your advantage, which leads to the next point, maximize your wins. It's not about your batting average, it's about how big your hits are. For timing, he's looking at liquidity and technicals, not just how cheap something looks. And when he has that conviction, he goes all in. But just as important, he knows how to take a loss. He's the best loser there is. No ego, just get out.
So all these rules, they combine into what we call a top-down or a global macro style. See, he's not just a stock picker. He starts with the huge, big-picture trends. What are interest rates doing? What are governments up to? Then, and only then, does he find the best way to play that idea. Maybe it's buying German bonds, maybe it's shorting Japanese stocks, or buying US dollars. Think of it like a queen on a chessboard. It's powerful because it can go in any direction. So can he.
You know, when you put it all together, Druckenmiller's whole career just screams this one powerful truth. The intellectual analysis, that's only half the battle. The other half is all psychological. It's fortitude. After all the research is done, when you see that one rare, glaring opportunity, the final question is always the same one. Do you have the courage to truly be a pig? That's the real challenge.
All right, let's talk about a true market maverick. Today, we're diving into the story of Richard Dryhouse, a legendary investor who built an absolutely phenomenal track record by, well, systematically breaking almost every single rule in the conventional investing playbook.
Okay, just look at this. Because to really get how different Dryhouse was, you have to see the results first. Between 1980 and 1991, if you had put just $1 into his small cap fund, it would have turned into more than $24. Now look at the market benchmark, the Russell 2000. That same dollar wouldn't have even turned into $5. I mean, that's not just beating the market, that's lapping it 5 times over. It's just staggering.
So, you have to ask the question, right? How on earth did he pull that off? What was he seeing that practically everyone else was missing? Well, that's the puzzle we're going to piece together in this explainer. Here's how we're going to break it all down. We'll start by looking at the sheer scale of his success. Then we'll trace back to his origins, decode his really unique philosophy, look at some of his biggest stock-picking wins, see how he handled a historic crash, and finally, boil it all down to the key lessons for you.
So for 12 straight years, starting in 1980, Dryhouse's main fund averaged an annual return of over 30%. Now, just to put that into perspective, that's more than double what the S&P 500 did during that same period. He wasn't just having a good run, he was playing a completely different game.
But you know, this kind of crazy success didn't just happen overnight. Actually, his whole journey kicked off with a failure, a really frustrating experience that basically forced him to tear up the rulebook and figure things out for himself.
It all started when he was just 13 years old. He'd saved up $1,000 from his paper route and he invested it, following the advice of the professionals. And what happened? He lost money. So, totally disheartened, he went to the library and just started reading everything he could. That's when he stumbled on his newsletter, America's Fastest Growing Companies, and boom, a light bulb went off. He saw clear as day that over the long haul, the thing that drove stock prices up was a company's ability to just keep growing its earnings year after year.
And this quote right here, this really captures his big aha moment. He was looking at these charts and he could literally see a company's earnings line and its stock price line moving together, almost in perfect harmony, over a decade. It was such a simple but powerful idea. A rising stock price is just an echo of rising earnings. That single visual became the absolute bedrock of his entire investing career.
So armed with this powerful insight, Dryhouse went on to build a philosophy that pretty much flew in the face of everything that Wall Street considered smart or prudent investing.
I mean, this chart says it all. It puts his ideas in a head-to-head battle with decades of investing dogma. You know, the conventional wisdom says you buy value, find good companies with a low price-to-earnings ratio. It tells you to be wary of stocks hitting new highs and to buy and hold for the long term. Well, Dryhouse just threw all of that out. He said for the kinds of explosive growth companies he wanted, the PE ratio was basically irrelevant. He didn't just buy stocks at new highs, he went looking for them. And get this, he believed that selling stocks quickly wasn't risky, it was actually the key to managing risk.
And here it is, his most radical idea. He completely flipped the old saying, buy low, sell high, on its head. Treehouse was convinced the real money, the big money, was made buying high and selling even higher. He wanted stocks that were already popular, stocks that were showing incredible momentum. Why try to guess when a falling stock will hit bottom when you could just hop on a rocket that's already taking off?
His take on risk was just as wild. Most people think high turnover, trading in and out of stocks a lot, is just reckless gambling. Treehouse saw it as a shield. To him, the real risk was holding on to a loser and just hoping it would come back. Instead, he used high turnover like a defensive tool to cut his losses super quickly, taking a bunch of small, survivable hits to make sure he never took one single catastrophic blow.
So that's the theory. It's a great story. But how did this radical philosophy actually hold up when real money was on the line? Well, let's get into some of his most legendary trades.
Back in 1986, Treehouse made the biggest bet of his entire career on a company that, honestly, a lot of people thought was just a silly gimmick, the Home Shopping Network.
So, HSN goes public at $18 a share and immediately skyrockets into the 40s on day one. Now, most investors would look at that and think, oh man, I missed the boat. But Treehouse, he looked past the price and straight at the numbers. In just its first 6 months, the company had already done $64 million in sales and banked $7 million in profit. The growth was just off the charts, and with cable TV expanding everywhere, its potential seemed endless. So he jumped in and started buying the stock in the 40s and 50s. And his reward? The stock blasted off to $200 within a few months.
But hey, it wasn't always that easy. Another one of his massive winners, a frozen yogurt company called TCBY, first tested his conviction in the most brutal way imaginable.
So Treehouse buys into TCB right at its IPO price of $7 a share. He absolutely loved the product and he saw incredible earnings growth ahead. And then the stock just fell off a cliff. It dropped nearly 40% down to just over $4. One of his clients even called him, questioning why they still owned it. But Treehouse's belief in the company's fundamentals and its growth story was just unshakable. He held on tight. And that patience paid off big time as the stock eventually climbed all the way to $200.
And his philosophy gave him the perfect context for what was happening. He knew the stock wasn't dropping because the company was in trouble, it was because the whole market was just cold on small growth stocks at that moment. He saw it was simply winter time for stocks like TCBY, and because he'd done his homework, he had the confidence to just wait for spring.
But the real test of any investment strategy isn't just surviving a bad stock pick, it's surviving a full-blown catastrophic market crash. And for Treehouse, that test arrived in October of 1987.
In one single month, his fund lost over a third of its value. Just try to imagine that, 34% of your net worth just gone in a matter of weeks. For almost anyone, that would be a moment of pure, blinding panic.
But Treehouse's reaction was the complete opposite of panic. He said he actually felt calm, almost detached, like he was an outside observer just watching the chaos unfold. He wasn't frozen by fear. He was processing everything with this just stunning level of composure.
So what was his secret? He'd already been through a terrible bear market before, back in 1973 and 74, and he'd made it through. That earlier trial by fire had forged his confidence. He knew deep down that he could take the hit, he could make the money back, and he would come out stronger on the other side. As he loved to say, quoting Nietzsche, "What does not destroy me makes me stronger."
So after all that, how do we wrap this up into some real, actionable lessons? What are the big takeaways from Richard Treehouse's incredible career?
Well, you can really boil it down to a 4-step playbook. First, it all begins with accelerating earnings growth. That is the engine that drives everything. Second, don't be scared to buy strong stocks that are already on the move. You got to embrace momentum. Third, be absolutely ruthless about cutting your losses. A bunch of small losses is just the cost of doing business to avoid a huge one. And finally, and this is probably the most important one, do the work to build your own core philosophy. You have to believe in it so deeply that you can stick with it even when things get really, really tough.
When you think about it, Treehouse's story is such a powerful lesson that real breakthrough success often means doing the very thing that feels uncomfortable or counterintuitive. He was buying when others were scared to death, he held on when others were panic selling, and he sold when others were still dreaming of more. It kind of leaves us with a great question to think about. What uncomfortable strategy, what widely accepted rule in your own life or career might actually be the key to unlocking your own success?
Have you ever heard of a trader who just doesn't lose? I mean, someone with a track record so consistent it seems to defy logic, maybe even the fundamental theories of how markets are supposed to work. Well, today, we're diving into the story of Gil Blake, a trader whose performance was so good it seems almost impossible. So the big question for us is, how in the world did he pull it off?
All right, let's just start with the numbers, because honestly, they're wild. For 12 straight years, Gil Blake pulled in an average annual return of 45%. Now, just to be clear, that's not a one-year fluke. That's his average for over a decade. That kind of performance puts you in a league of your own, way beyond what even the top pros hope for.
But here's what really makes his story just unbelievable. It wasn't just the huge returns, it was his mind-bending consistency. 96% of the months he traded were profitable. Think about that. Out of 139 months of trading, he made money in 134 of them. He almost never had a down month. It's just staggering.
And it gets even crazier. At one point, Blake strung together 65 winning months in a row. That's over 5 straight years without a single losing month. You know, to give you some perspective, the baseball legend Joe DiMaggio had his famous hitting streak that lasted 56 games. Blake's streak was even longer. It's just on another level.
So how does something like this even happen? Okay, here's how we're going to break this down. We're going to look at his background as a total Wall Street outsider. We'll get into this simple little observation that changed everything for him, see how his strategy had to evolve, and then really try to understand his unique philosophy. Finally, we'll pull out the key lessons from this absolute market wizard.
So to really get his success, you have to start with his background. Because Gil Blake was not your typical master trader, not even close. He wasn't some hotshot from a trading desk. Actually, for years, he was a die-hard believer that beating the market was totally impossible.
See, Blake graduated with the highest honors from Wharton Business School. And there, he was taught and he really truly believed in the random walk theory. Basically, the idea is that market movements are random and totally unpredictable. So the whole concept of trading for a living, he thought it was a fool's errand.
And his career path really shows you where his head was at. After Cornell, he's in the Navy on a nuclear sub. Then he becomes an accountant, and then spends almost a decade as a CFO. For 15 years after college, trading wasn't even a thought in his mind. He was building a very serious, very conventional career.
So, what could possibly change the mind of a guy who was so convinced the markets were just random noise? Well, the whole journey started with a simple, almost trivial observation from a friend. An observation that Blake at first just brushed off as a complete fluke. So the story goes, a friend shows him the performance of this municipal bond fund. Now it was paying high interest, but its NAV, that's just the share price of the fund, was just dropping day after day after day. And his friend asked a simple question. Why not just switch into cash when it starts to go down? Blake's first reaction was probably a scoff. Yeah, right. Random walk, remember? But that little seed of an idea was planted. When his friend came back with even more data showing the same strange pattern, Blake's curiosity finally got the best of him. He started digging, and he could not believe what he was seeing. He found this incredibly powerful non-random pattern. He called it the 1 penny rule. If the fund's value changed by just 1 penny, there was an 83% chance it would move in the same direction the next day. This was a huge crack in his whole random walk worldview. And from that discovery, he built his very first trading system. And it was just beautiful in its simplicity. If the fund's NAV went up by a penny, he stayed in. If it went down by a penny, he switched his money over to a cash fund. It was simple if-then logic that let him catch the upside while pretty much dodging all of the downside.
And the results? They were absolutely stunning. From 1980 to 1981, the bond market was getting crushed. The fund itself lost nearly half its value. But Blake's simple little switching method? It was generating gains of over 20% a year, not even counting another 10% in interest. He had proven his old beliefs completely wrong.
But here's the thing about the markets, as any great trader will tell you, they don't stand still. Over time, that volatility in municipal bonds started to dry up, and the pattern wasn't as reliable anymore. His first big edge was starting to fade, and he knew if he wanted to survive, he had to adapt. So, Blake basically moved into the local library. I mean, he's poring over old microfilm data for hundreds of mutual funds, just hunting for a new edge.
He noticed that funds tied to commodities seemed to have stronger trends, which led him to ask this one crucial question, a question that was about to unlock his next huge breakthrough.
He came up with this brilliant analogy. He realized that a single stock's direction is only slightly predictable. Maybe a 55% chance it continues its trend, kind of like a single coin toss that's just slightly weighted. But what if you toss 99 of those biased coins? Well, the probability of getting more heads than tails jumps up dramatically to around 75%.
And this is where it all clicked. He realized that sector funds that hold a bunch of very similar stocks, like all biotech or all energy stocks, they behave like that stack of 99 biased coins. They tend to move together, like a school of fish. And that made the direction of the whole group way more predictable than any single stock inside it.
Okay, so having a system is one thing, but having this psychological fortitude to actually follow it, day in and day out, that's a whole other ballgame. And this is where Blake's philosophy was so important. His way of thinking was just as unconventional as his methods, and it was really the secret to his legendary consistency.
First off, he threw the entire idea of traditional diversification right out the window. Instead of spreading his money around, he would bet 100% of his capital on one single sector fund at a time. His logic? He said his diversification came from making a lot of trades over the course of the year. As he put it, if your odds are 70% in your favor and you make 50 trades, it's pretty darn hard to have a losing year.
His approach to risk was also totally unique. Before he even put on a trade, he would mentally rehearse losing on it. He would imagine the worst possible outcome, how he'd feel, what he'd do. By confronting and really embracing the potential for loss before it happened, he basically removed fear and confusion from his process when the pressure was on.
These principles were like his personal commandments. He said discipline was everything, and he compared breaking a trading rule to breaking a diet. You do it once, and the next time is that much easier. He even used his own emotions as a trading signal. If a loss still bugged him after a day, he knew he was trading too big. And he never, ever stopped researching, because he knew that in the markets, you either adapt or you die.
So, after going through his incredible journey, what can we actually take away from Gil Blake's career? Well, he managed to boil down his success into a few core principles that really offer a powerful roadmap for anyone interested in navigating the markets. Blake laid out this 5-step process. First, find a style that actually fits your personality. Second, find a market anomaly, some kind of inefficiency. Third, prove to yourself with stats that it's real. Fourth, create ironclad rules around it. And then, number 5, the hardest part of all, follow those rules with no exceptions. He said it really all boils down to 2 things: the independence to do your own thing and the discipline to do the right thing.
But if you really look past all the systems and the rules, his success truly hinged on 2 fundamental character traits. First, this incredible open-mindedness that allowed him, a guy who was a staunch believer in random markets, to completely flip his worldview when he was faced with new evidence. And second, a deep-seated adaptability that pushed him to evolve the second his old methods started to fail.
In the end, Gil Blake would probably agree with the academics. The markets are mostly random. But his entire career is this powerful, compelling proof that they're not completely random. His story shows us that the market can be beaten. It's not easy, and you can't do it by buying some system in a box. But it can be done by those who have the creativity to find a real edge and, maybe most importantly, the unwavering discipline to exploit it.
All right, today we're going to get inside the mind of a true market wizard, Victor Sparandio. Now this guy is a legend. We're talking about someone who strung together 18 winning years in a row with an average annual gain of 72%. I mean, just let that sink in. But his wisdom, it goes way beyond just the numbers. He developed this really unique philosophy that mixes stats, risk management, and a deep, deep understanding of human psychology. So let's unpack the wisdom of a master.
And right away, we start with a paradox, something that just doesn't seem to make sense. Sparandio says this after decades of incredible success, after reading over 2,500 books on markets and economics. So it makes you wonder, right? If knowing more doesn't guarantee you'll win, what does? This single, counterintuitive idea is really the key to understanding his entire way of thinking.
You see, Sparandio's journey, it didn't start in some Ivy League business school. Nope. It started at the poker table, and that's where he learned a totally different way of looking at risk.
His path to Wall Street was anything but traditional. He was a total outsider who had to build his own system from scratch, really just to get a fair shot at the game. When he was just a teenager, Sperandeo was literally making a living playing poker. And it was there he learned this absolutely crucial distinction, the difference between speculating and gambling. He figured out pretty quick that winning wasn't about luck or getting a good hand. It was about managing the odds, knowing which hands to play because probability was on your side, and knowing when to fold. This whole mindset of calculated risk, that's exactly what he brought with him to the financial markets. His early career on Wall Street? Well, it was a masterclass in frustration. He said his first jobs were stupefyingly boring, and he was always fighting against these unfair pay structures. I mean, imagine being promised a cut of your profits, making a killing for your boss, and then he tries to switch you to a low salary. He'd had enough. He realized the only way to guarantee a fair deal was to create it himself. So that's what he did. He launched Ragnar Options in 1971, and by simply offering fair, guaranteed quotes, his firm dominated the market almost overnight.
And this quote, this gets to the absolute heart of his philosophy. For Sperandeo, the number one goal was never about chasing huge, flashy gains. It was about preserving his capital. He knew that if you get knocked out of the game, you can never win. It's as simple as that. This defense-first mindset is exactly what allowed him to survive and thrive for decades.
Okay, so this focus on staying in business, on preserving capital, it led Sperandeo to his most revolutionary idea. He came up with a completely new way of looking at markets. He proposed this theory that trends, just like people, have a life cycle, and that understanding that cycle is the ultimate key to managing your risk.
This was the question that just haunted him after he missed a massive stock market rally back in 1974. That one mistake kicked off an intense 2-year study. He wanted to know, how long do these bull and bear markets usually last? What do normal price moves look like? He was basically searching for a statistical baseline to understand how markets really behave. And this is the key number he uncovered. After digging through almost a century of data, he found that the median upswing in a bull market was about 20%. Now, this wasn't some kind of crystal ball to predict the future. No, it was a statistical benchmark, like an actuarial table, to help him gauge whether a market trend was young and healthy or old and getting close to the end.
His whole concept is probably best understood with this really cool analogy. Think of a market the way an insurance actuary thinks about a person. A young, healthy market, that's like a 20-year-old. It can shrug off bad news, right? It's resilient. The risk is pretty low. But an old market, one that's already rallied, say 30%, that's like an 80-year-old. It's fragile. Any little piece of bad news, any negative symptom, suddenly becomes a huge deal. The risk premium is just so much higher.
So how do you actually use this? Well, it's a 3-step process. First, you figure out the market's age using those statistical benchmarks. Second, if the market is old, you become hyper-vigilant. You're watching for any symptoms of weakness. A bearish chart pattern that you might have ignored in a young market, now it's a critical warning sign. And finally, and this is the most important part, you adjust your risk. You reduce your bet size as that trend's life expectancy starts to go down.
This quote just perfectly sums up the entire idea. Most people trade without this kind of context. They use the same strategies, the same risk levels, no matter what the market is doing. And as Sperandeo points out, that's like an insurance company charging the same price to a 20-year-old and an 80-year-old. It's just a recipe for disaster.
So Sperandeo develops this incredible statistical framework. But then he discovered that even with the best data in the world, the real key to success wasn't in the numbers at all. It was in your head. In fact, he found that pure intelligence, having a high IQ, could actually be a massive handicap.
To try and grow his business, Sperandeo once tried to become what he called the McDonald's of trading. Over 5 years, he trained 38 people, teaching them literally everything he knew. And the result? Only 5 of them actually made money. This whole experiment proved to him that knowledge was not the deciding factor. The secret ingredient was emotional discipline.
And the perfect illustration of this was 2 of his trainees. One was a certified genius with a 188 IQ. In 5 years, he never made a dime. Why? Because he was so used to being the smartest guy in the room that he just couldn't admit when he was wrong. He'd put his own intellect above what the market was telling him. Now, on the other extreme, you had a high school dropout, a Vietnam vet who was, in Sperandeo's own words, afraid of everything. And you know what? That fear made him cautious. He was more worried about losing money than making it, so he took his losses immediately, and he made a fortune.
And this is what revealed the crucial point. Success in trading isn't about proving you're right. It's about having the humility to quickly accept when you're wrong, cut the loss, and save your capital so you can play the next hand. The market, it just doesn't care about your IQ or your degree.
You know, in most jobs, you can kind of rationalize failure or blame someone else. A lawyer can blame a biased jury. But in trading, there is nowhere to hide. Your account balance is a brutally honest report card every single day. And the trader who tries to rationalize their losses, well, they're on a guaranteed road to ruin.
So how did Sperandeo manage to enforce this emotional discipline day in and day out? He didn't just rely on philosophy. He built a concrete business plan. He treated trading not like a game of hunches, but like a structured business with a really clear hierarchy of goals.
And here it is. It's like a pyramid. The foundation, Tier 1, is preserving your capital. His first question was never, how much can I make? It was always, how much am I willing to lose? Then comes Tier 2, which is all about striving for consistent, steady profits. And only after he mastered defense and consistency does he even think about moving to Tier 3, going for those huge, superior returns by betting bigger, but only when he's already trading well.
And these are the non-negotiable rules that hold that whole business plan together. Notice how they're all designed to take emotion completely out of the equation. By deciding your exit point before you even get into a trade, a small loss just becomes a planned business expense, not some kind of emotional failure. When you're in a slump, you trade smaller, not bigger. And when you are betting big, you demand that the trade works right away, or you get out fast.
Okay, so we've got the theory of market age, the psychology of discipline, and the structure of a business plan. Now, let's see how Sperandeo put it all together to make one of the most legendary market calls in history.
This is a perfect case study. By August of 1987, the market was statistically ancient. It had rallied way past that 20% benchmark. More importantly, it was showing all the classic symptoms of sickness. Valuations were at record highs, and the technical charts were flashing all these warning signs that most people were just ignoring. To Sperandeo, the risk premium was through the roof. Then, the catalyst came. A warning from the Fed chairman, followed by a classic technical sell signal. That's when he put on his short position. The final trigger was just an ill-timed comment about devaluing the dollar, which sparked a panic. The market collapsed, and Sparandeo's entire framework was proven right. So what are the big lessons we can take away from all this? First, emotional toughness is way more valuable than raw IQ. Second, you have to treat trading like a business, with defense as your #1 priority. Third, be really wary of dogma, like buy and hold forever. Sperandeo points out there were multiple decades-long periods where that strategy would have just lost you money. And finally, a lesson that goes way beyond the market. While he was doing that intensive 2-year study, Sperandeo was so consumed by it that he missed precious time with his young daughter. He gives this warning that while dedication is absolutely necessary, you can't let the market become your entire life. It's a really powerful reminder that the ultimate goal is a balanced, satisfying life, not just a bigger account balance.
And that brings us to the final, and I think most provocative question. It's really the essence of all of Sperandeo's wisdom. Success isn't about always being right. It's about developing the skill, the emotional discipline to admit when you're wrong quickly, gracefully, and without any ego. It's a question every single one of us can ask ourselves, not just in the markets, but in life.
All right, today we are diving into the mind of a trader who might just completely change how you think about success. He's a guy they nicknamed Mr. Serenity, and believe me, his story really challenges everything we assume about the high-stress world of finance. So let's just start with a really simple question that this successful fund manager, Tom Basso, kind of forces you to ask yourself, and it's a question that gets right to the heart of what we're all chasing. You know, for so many people, especially in finance, success is spelled M-O-S-T-B-U-C-K-S. It's this relentless, kind of stressful race to get the highest return possible. But Basso, he has a totally different spelling. G-O-O-D-B-U-C-K-S, G-R-A-U-T-L-I-F-E. And this isn't just some catchy little phrase. It is literally the foundation of his entire way of thinking. So here's how we're going to break down his journey. We'll look at how he redefined success, then go back to his very anxious beginnings. We'll cover the tough lessons that shaped him, the serene mindset that really sets him apart, and finally, how all of this connects to a much bigger philosophy on life. All right, let's get into it. Okay, first up, let's get a handle on who Tom Basso actually is. If you only look at his track record, yeah, it's solid, it's very respectable. But just looking at the numbers, you wouldn't call it legendary. I mean, look, he consistently beat the market averages, and that is a huge achievement. But if you think these numbers are the most impressive thing about Tom Basso, you are completely missing the real story here. These figures, they're just the tip of the iceberg. The real story is in how he got these returns. He managed all of this while being completely serene. I mean, the total polar opposite of that high-stress, stomach-in-knots image we all have of a typical trader. He actually found real joy in the process, not just in the money at the end. But here's the thing, he wasn't born Mr. Serenity, not even close. His journey started from a place of just pure, unfiltered anxiety. This is how he felt after his very first trade back in 1975. He was an engineer, had a small $2,000 account, and he bought 2 corn contracts. He lost $600 almost immediately, and the emotional toll was just massive. He was basically just like every other nervous beginner out there. And his first few years, they were absolutely brutal. He lost money for 5 years straight. Now, most people would have just given up, right? They'd figure, okay, this isn't for me. But Basso? He never even thought about quitting. So what kept him in the game? Well, his confidence wasn't coming from wins because there weren't any. It was built on progress. He could see that even though he was losing, he was improving. His losses got a little smaller every single year. That was the positive reinforcement he needed to stick with it. He actually called this really painful time his college of trading. You know, every loss was just tuition he had to pay for a valuable lesson. And in that college, there were 2 experiences in particular that were absolutely pivotal. They changed everything for him. So, back in 1979, his parents came to visit for a week. He was busy being a tour guide, showing them around, and he got behind on his market homework. And of course, during that exact week, silver had a massive breakout, and his system gave a buy signal that he just completely missed. That one little slip-up, that single missed trade on a tiny account of only $5,000 cost him a potential $30,000 profit per contracts. That would have multiplied his account by 6 times. I mean, can you imagine the pain of that missed opportunity? It must have been staggering. That lesson was just burned into his brain. Discipline and consistency, they are not optional. They are literally everything. This just shows you how committed he was to learning from his mistakes and turning a really expensive error into a core rule for the rest of his career. So years later, another silver trade taught him a totally different lesson, this time about emotional control. His account just shot up by $500,000 in 1 month. I mean, what a rush. But then, in just 1 week, he gave back 80% of that gain. He realized that emotional roller coaster of huge swings, it just wasn't sustainable. So all of these painful, really expensive lessons, they became the building blocks for his psychological fortress. They basically forced him to develop a toolkit to manage not the markets, but to manage himself. So let's break down the tools he uses to stay so incredibly calm. He pretty much boils his whole approach down to 3 key practices. First, mental rehearsal. He literally pictures worst-case scenarios and plans his response, so if they ever happen, he's ready. Second is detached observation, and we'll dig into that in a second. And third, always keeping a long-term view, which makes any one trade feel, pretty insignificant. A really key idea here is something he calls disassociation. It's all about creating this observer version of yourself. This observer can watch you, the trader, and give you advice without any emotion. It can say, hey, you're getting a little greedy, or, you don't have to make a trade right now. It's this amazing way to step outside of yourself and stop being hijacked by fear or excitement. And he really put this to the ultimate test. During the Gulf War, the oil market just went completely nuts. Overnight, a huge gain in his portfolio swung to a 15% loss. So how did he feel? He said he felt phenomenally good. Why? Because he had mentally rehearsed for a disaster, and when it happened, he executed his plan perfectly, just like that calm doctor in a battlefield emergency room. And this is where it all comes together, because this powerful mindset, it ends up extending way beyond his trading desk and into his whole philosophy on life. The tools he built to survive the markets, they became the tools he used to thrive in the world. If he had to start all over, he said he'd completely reverse how he learned. When he was starting out, he was obsessed with the system, the buy and sell signals. Now, he believes psychology is by far the most important thing. Then comes risk control, and the actual trading system, he says that's the least important piece of the entire puzzle. He makes this case that if you can adopt that observer mindset, you can actually view your life as if it were a movie. You can experience everything, all the joy, the sadness, the drama, with this incredible intensity, but you're not totally overwhelmed by it because you have the perspective that you're both the actor and the audience. And it's so important to get this detached observer perspective. It's not about being passive or checked out. It's actually the opposite. It's about being completely present without getting emotionally wrecked by everything, which lets you actually enjoy the journey, not just grit your teeth and endure it. So we'll end with Basso's main idea, but framed as a question for you. It really captures his entire approach to finding not just good bucks, but a great life. And it challenges us to ask ourselves, are we the calm observer in our own story, or are we just a character getting tossed around by every single twist and turn? Today, we're digging into the incredible story of Linda Bradford Raschke. She's a trader whose passion for the markets is, well, it's pretty much a force of nature. See, she doesn't just look at charts, she reads them. Like a musician reads a score, finding rhythms and melodies that almost everyone else misses. And if you need any proof of that passion, right there, that's it. This one sentence tells you just about everything you need to know. For Linda Raschke, this isn't a job, it's a calling. Something so deep that not even childbirth could press the pause button for very long. This is the story of that focus, that relentless drive. So where in the world does a drive like that even come from? Well, it wasn't something that just appeared overnight. This was a fire that was lit way back in her childhood, and believe me, it was tested by some serious obstacles long before she ever made her first professional trade. Her journey really did start early. As a kid, she'd help her dad sift through hundreds of stock charts, hunting for patterns. Then in college, she was picked to help manage a student trust fund, which she said was an awful lot of fun. But, after graduating, reality check. Every single brokerage firm in San Francisco turned her down flat. But she was undeterred. She took a corporate job right near the Pacific Coast Stock Exchange and just spent every single morning before work watching, soaking it all in. And while she was watching, she figured something out, something really important. Success on that floor wasn't about having an Ivy League degree or a PhD. The floor was full of all kinds of people. And the ones who were really killing it, like those surf bums she talks about, they just had an intuitive feel for the market's rhythm. Passion, it turned out, was way more important than a fancy education. All that time she spent just watching, asking questions, and showing this incredible enthusiasm, none of it was wasted. It was basically her audition. And that persistence, it was about to pay off big time, launching her from a spectator in the stands right into the main event. You see, one of the traders on the floor noticed her. He was so blown away by her relentless interest and how quickly she was picking up options trading that he made her an offer. He said he'd put up $25,000 to back her. And just like that, Linda Raschke was a professional trader. It was her passion, not her resume, that finally opened that door. And boy, did she hit the ground running. The options market back then was, as she put it, incredibly inefficient, which basically means you didn't have to be a genius to make money. In just her first 3 months, she doubled her stake, pulling in a $25,000 profit. That early success was a huge confidence builder. It proved her instincts were dead on. But trading, well, it has a way of humbling you, even when you're on top of the world. Riding high on that initial success, she was about to face an absolute catastrophe. A single trade that would not only wipe her out, but would also forge the incredible resilience that would define the rest of her career. So here's the setup. She was selling options on a stock called Citi Service. Now, she knew it was a takeover target, which made the options seem overpriced and really tempting to sell. Her math was pretty simple. As long as the stock price stayed under $55, she was golden. And with the stock trading around 32, it felt like a pretty safe bet. It wasn't. The afternoon right before those options expired, the takeover was announced. And the stock didn't just go up, it exploded. It rocketed from the low 30s all the way to $65 overnight. In a flash, she lost everything. Her initial $25,000, her $25,000 in profits, and she was still $30,000 in the hole. She was just 22 years old and already deep in debt.
Now, most people would be absolutely crushed by that. But her reaction? It was extraordinary. See, she'd watched other traders on the floor take hits worth millions and survive. So to her, her loss felt manageable. She just had this unshakable belief that in a business where you could lose money that fast, you could also make it back just as fast. Getting through that disaster gave her the core confidence that would carry her for the rest of her career. Years later, something else totally unexpected would reshape her career. A really bad horse riding accident meant she physically couldn't stand on the trading floor anymore. This forced her to trade from an office, and this change of scenery, it became the unlikely catalyst for her signature strategy, mastering the short-term swing. Her whole philosophy is actually grounded in a scientific idea called chaos theory. Think about it like forecasting the weather. A meteorologist can tell you with pretty good accuracy if it's going to rain tomorrow, right? But they have no idea what the weather will be a year from now. Raschke believes the markets work the exact same way. The long-term future is just too random, so only short-term moves can be predicted with any real precision. To make this practical, she uses a simple but really powerful analogy. The market is like a rubber band. You've got price moving around some central equilibrium level. When panic or total euphoria stretches that rubber band way too far in one direction, you know it's got to snap back. So her entire job is to wait for that moment of maximum tension when that rubber band is stretched to its absolute limit and then trade the snapback. And she follows a very strict set of rules. For her, the ideal trade lasts about 10 days, but she goes into every single one thinking it'll only last 2 or 3. She never sets price targets. She just predicts the direction and gets out when the momentum shifts. She is obsessed with getting the best possible entry price. And here's one of her most important rules. If a trade goes south, your goal is no longer about making a profit. Your only job is to find the best possible place to exit, period. Okay, so now we get to the most fascinating part of her whole approach. Raschke is convinced that her single most important skill as a trader, her ability to see these patterns, it doesn't come from economics at all. It comes from her deep background as a classical musician. And when you look at it, the parallels are kind of stunning. A musical score is just symbols and patterns, right? So is a market chart. Music has repeating themes that have little variations. Markets have repeating patterns with their own variations. A piece of music builds to this big crescendo. A market has a runaway price move. You have quiet moments in music and you have price consolidations in markets. To her, reading one was just like reading the other. But it's more than just recognizing patterns. The very act of practicing an instrument for hours every single day, from age 5 all the way to 21, it instilled in her the two things that are absolutely critical for a trader: discipline and concentration. It's not just about what you can see, it's about the mental toughness you build through that rigorous daily practice. So what about being a woman in such a male-dominated field? Well, Raschke has a really clear take on it. She says that at the end of the day, performance is all that matters. If you can produce the numbers, you will get backing. But she does think women might have some built-in advantages. They're maybe less likely to get into those macho-type trades that are all about ego, and they might be more comfortable just relying on pure intuition, that gut feeling for when a price has moved just enough. Okay, so after this long, incredible career, what are the big lessons she wants to pass on? Let's break down her most powerful advice for anyone who's trying to find their way in the markets. Her favorite exercise for new traders is super hands-on. She says, pick just one market. That's it. Then, for a whole week, you write down the price every 5 minutes, all day long. And here's the kicker. You do it without looking at a chart. The whole point is to force yourself to get in tune with the market's internal rhythm, to actually feel the support and resistance levels, and notice how it acts at different times of the day. It's about building an intuitive feel that a chart just can't teach you. Her final advice is really direct. You have to be all in. Immerse yourself completely. Give up everything else. You need to specialize in one thing and master it before you even think about expanding. Never be afraid of the markets and never be afraid to make a mistake. But when you do make one, you fix it immediately. Don't be greedy. It is always okay to leave some money on the table. And maybe most important of all, do your own work. If you find yourself asking someone else for their opinion, that's a huge red flag that you should probably just get out of your trade.
You know, Linda Raschke's story is about so much more than just trading. It's really about passion, it's about resilience, and it's about the power of dedicated practice to see the things that other people just don't. And it leaves us with a pretty interesting question, doesn't it? Whether it's in our careers, our relationships, whatever. What hidden music, what underlying patterns could we all start to hear if we just learned to listen with that same kind of discipline and focus?
All right, today we're pulling back the curtain on one of the most legendary and honestly most secretive firms in trading history, Chicago Research and Trading, or CRT. We're going to break down how they built this incredible financial engine that seemed to just completely defy the laws of the market.
So picture this. You're standing on a chaotic trading floor. You've just lost a fortune, and you look over at a competitor and say this: "You guys make money every day." That one sentence, just dripping with envy and admiration, perfectly captures the whole myth of CRT. And the craziest part? The guy who said it wasn't really exaggerating.
Just let that sink in for a second. We're talking about the financial markets, right? A world that's wildly unpredictable, where even the smartest traders can get wiped out overnight. But CRT? Well, they had somehow cracked the code. They weren't just profitable most of the time. They were profitable pretty much every single month, sometimes every single week. That kind of consistency is, well, it's almost unheard of, even today. To even start to wrap your head around how they did this, you have to understand the sheer scale we're talking about. Over about 15 years, CRT's transactions were valued at over $10 trillion. Yeah, that's trillion with a T. That's a number you usually hear when people are talking about the debt of an entire country. They were an absolute force of nature. And out of that massive, constant river of trades, the firm pulled in an estimated $1 billion in trading profits. It's just a staggering figure. And it gets even more incredible when you find out the firm's founder, a guy named Joe Ritchie, started out so broke he literally had to borrow a suit just to get his foot in the door on the trading floor.
And look, this wasn't some little two-person shop. At its peak, this money-making machine had a team of 800 employees. This was a big, complex, sprawling organization that had somehow managed to achieve a level of consistency that just seemed impossible.
So that brings us to the big question, right? How did they do it? How in the world did CRT build a system that came so close to being a perfect, flawless trading machine? Well, we're going to unpack the 3 key pillars that let them do it.
Okay, so the first piece of the puzzle is their whole approach to the market. CRT's philosophy was the complete opposite of that typical high-stakes Wall Street mentality. See, they weren't trying to hit home runs.
So on one side, you've got the classic Wall Street approach, right? Swinging for the fences, hunting for that one huge, risky trade that could make your year. CRT, they did the exact opposite. Their entire business was built on making thousands and thousands of tiny, modest profits from small, temporary glitches in the market, all while obsessively, relentlessly keeping their total risk as close to zero as possible.
Now, the technical term for this is arbitrage, but really, all it means is they were masters at finding moments where the exact same thing was priced just a little bit differently in 2 different places. You know, like if options on the Chicago Exchange were a fraction of a penny cheaper than on the Pacific Exchange, boom, CRT would instantly buy the cheap one and sell the expensive one and just pocket that tiny difference.
And the way they did this, it was a system of just breathtaking speed and precision. First, their computer models would flash a signal, an opportunity. A floor trader would immediately buy it. At the same time, they'd be using hand signals to communicate across the chaotic pit to a clerk, who'd get a futures trader to place the opposite trade, the hedge, all within seconds. Then the whole position will get passed to a manager upstairs whose only job was to constantly balance the firm's books, making sure their overall risk was always zero. It was like a perfectly choreographed dance, repeated thousands of times a day.
But look, a strategy like that, hunting thousands of tiny opportunities every single day, it's totally impossible without some serious technological firepower. And that was the second pillar of their success, a state-of-the-art command center that was, no joke, years ahead of its time. And we're not talking about a few powerful PCs here. CRT had almost an entire floor of the Sears Tower dedicated just to computers. Their systems were tracking 75 different markets across 19 exchanges around the world all at once. They wrote all their own software, had their own on-site repair unit so nothing was ever down for long, and they even had a completely separate backup risk team. They built themselves into a technological fortress. But here's the crucial part. All that computing power wasn't for finding the next big, risky bet. It was for defense. The #1 goal of their entire tech setup was to analyze thousands of variables in real time so the firm could squash its risk, getting it as close to absolute zero as was humanly and technologically possible. And the software they built was brilliant. They figured, the human brain is great at processing pictures, not endless streams of numbers. So they translated all this overwhelming data into these intuitive 3D graphic displays. This meant a trader could literally see the firm's entire complex position in a single color-coded picture. It was a massive advantage over their competitors who were just staring at spreadsheets.
So at this point, you're probably thinking, okay, I get it. The secret was just having bigger and better computers than everyone else. And, that's a pretty logical conclusion. But it's not the whole story. Actually, it's not even the most important part.
Because if you asked anyone who actually worked at CRT what the real secret was, they wouldn't point to the computers, they wouldn't point to the algorithms. Almost every single one of them would tell you that the secret ingredient was teamwork. I know, it might sound a little corny for the cutthroat world of finance, but it was the essential glue that held the whole machine together.
And that brings us to the final, and honestly the most surprising piece of the CRT puzzle, a radically different culture. This was the ghost in the machine. It was the human element that truly set them apart from everybody else.
This quote from a former trader, it really says it all. On a normal trading floor, if a trade went bad, it was a chaotic blame game, everyone for themselves. But at CRT, there was this deep culture of trust. That psychological safety meant that traders could make split-second decisions on huge orders without being terrified of getting scapegoated. And that gave them a critical speed advantage over rivals who had to call upstairs and get permission for everything.
Here's another perfect example. At other firms, traders were constantly slipping their clerks cash, $100 bills, just to get faster service. At CRT, the whole philosophy was different. They built relationships based on respect. They believed that a team member who feels valued is going to give you way better, more reliable service than someone you just bribed. And you know what? It worked.
So just forget that Hollywood image of traders screaming into phones, right? The CRT floor was quiet. It was calm. People said it felt almost like a university campus. All that stress and anxiety you'd see at other firms was replaced with this focused, collaborative vibe. People wore jeans, not suits. It was the absolute opposite of every stereotype you've ever heard about a trading floor.
And this culture wasn't some happy accident. It was deliberately built, from the top down. The founder, Joe Ritchie, was famous for being committed to sharing the profits fairly with everyone. They had a central cafeteria with home-cooked food, a lounge area right on the trading floor to get people talking, and they had a strict no-jerks policy. If you were a self-centered maverick trader, it didn't matter how good you were. CRT was not the place for you.
So when you put all three pieces together, you see it wasn't just one thing. It was this perfectly integrated system. The strategy was the blueprint, how to make money. The technology was the engine, giving them the raw speed to pull it off. But it was the culture, the people. That was the operator. It was the trust and teamwork that made the whole machine actually work at its absolute peak.
And really, that's the ultimate takeaway here. CRT's trading machine wasn't the hardware in the server room. It was the entire organization, firing on all cylinders. Their true innovation wasn't just a trading strategy or 3D graphics, it was the totally radical idea of combining that technology with a human-first culture built on a solid foundation of trust.
Which kind of leaves us with a final thought for today. As trading gets more and more dominated by AI and algorithms, what is CRT's real legacy? Is it the incredible technology they built? Or is it their revolutionary, and maybe now forgotten, focus on the unbelievable power of people working together? It's definitely something to think about.
Today, we're diving into the story of a real legend, a true enigma from the financial world, Mark Ritchie. Now, this guy was a master trader, a giant in the chaotic, screaming pits of the Chicago Board of Trade. But here's the twist. His journey didn't start at Harvard Business School or some fancy internship on Wall Street. Nope, it started in divinity school.
And that right there is the million-dollar question, isn't it? How on earth does a man studying the philosophy of religion, a guy who worked nights as a prison guard just to pay the bills, become one of the most successful traders of his entire generation? It's a journey from the sacred to what a lot of people would definitely call the profane.
You know, this quote just says it all. It perfectly captures the puzzle of Mark Ritchie. I mean, this isn't just an unusual career path, it's almost unbelievable. It makes you question everything you think you know about what it takes to win in the high-stakes, high-pressure world of the markets. So let's start pulling back the layers and see how he did it.
So, how are we going to tackle a story like this? Well, here's our game plan. We'll start with his really improbable beginnings. Then we'll look at a key moment, a pretty unethical experience actually, that totally shaped him. From there, we'll get into the core principles he lived by, explore what drove him beyond just making money,
and then we'll wrap up with this final piece of advice, which, trust me, is going to surprise you.
Okay, so let's set the scene. Our story really kicks off with this massive contrast between the world Mark Ritchie came from and the one he was about to dive into head first. It's like the ultimate fish out of water story, except this one has millions and millions of dollars on the line.
So just look at this. On one side, you have Mark Ritchie, the divinity student, thinking about these huge spiritual questions, so broke he sometimes couldn't even afford to fill his gas tank. And on the other side, you have the Chicago Board of Trade, this absolute temple of capitalism, where people were screaming, using hand signals, and betting fortunes on things called soybean crush spreads. The two worlds couldn't be more different.
And this was the moment everything changed. He went to visit the exchange with his brother Joe, and at first, it was quiet, kind of boring, but then the opening bell rang. He described it as this ear-shattering dong that just unleashed total, absolute pandemonium. In that explosion of raw human chaos, where pretty much anyone else would see just madness, he and his brother saw an adventure. They thought it looked like a ton of fun, and just like that, they were hooked.
But before Ritchie ever found real success, he got a crash course in the industry's dark underbelly. His very first job off the trading floor lasted exactly 1 day, and it was an experience that would shape his views on ethics forever. He had, completely by accident, walked right into a boiler room.
Now, for anyone who's not familiar, a boiler room is basically a scam factory disguised as a brokerage firm. It's a bunch of salespeople in a room, cold calling people and using high-pressure tactics and just outright lies to sell them worthless investments. The whole business is built on trickery, not skill. And a young, very curious Mark Ritchie had just signed up for their training program.
See, Ritchie was already thinking like a real trader. He wanted to know the odds, the track record, the actual numbers. So when he started asking the instructor super basic questions like, so what kind of returns are clients actually getting? He just set this wall of suspicion. The guy's hostile look said it all. You are not supposed to ask that. The goal wasn't to perform, it was to sign the guy up.
So then Ritchie corners him with a question that gets to the very heart of how markets work. He knew that any real market has two sides, a price to buy and a price to sell. When the instructor kept dodging, Ritchie pushed harder, asking, essentially, okay, what did you pay for this thing you're trying to sell me for $4,000? He was asking to see the other side of the deal, the one they were desperately trying to keep hidden.
And right here, the whole act just crumbles. The instructor, completely trapped, just drops the facade. He tries to compare himself to a furniture salesman, and then, with total aggression, he just tells Ritchie to fuck off. In that one moment, the whole scam was laid bare. Ritchie realized these guys weren't just conning the public, they were conning themselves. He walked out that day and never, ever looked back.
So that trial by fire, combined with years spent in the chaos of the actual trading pits, that's what helped Ritchie forge his own set of brutally effective principles. And these weren't some abstract theories from a textbook. These were survival rules, hammered out in one of the toughest, most competitive environments on the planet.
This is maybe the single most important question a trader has to answer, because if you get it wrong, you blow up. It is literally that simple. But if you get it right, you live to trade another day. And Ritchie's answer wasn't some complex formula. It was a gut feeling, a lesson he learned by watching other people fail big time.
Ritchie tells this incredible story about another trader who was worried he was taking on too much risk. The guy had 50 contracts with only $25,000 in his account, and it was money he really couldn't afford to lose. Now, Ritchie himself had double that position, 100 contracts, but it was backed by $1 million account, and even he felt a little nervous. That other guy, he wasn't just over-leveraged, he was a walking time bomb. And of course, the market moved against him, he was completely wiped out, and he left his broker with a massive debt.
And here is Ritchie's brilliant answer. It is just so simple, it's profound. If a trade is taking up so much space in your head that you can't sleep, it's too big. Period. Your own mind is the best risk indicator you've got. He even had a spiritual version of this. If he ever found himself praying for a trade to work out, he'd get out of it immediately. Because, as he said, God is not a market manipulator.
Now check this out. This same idea of mental toughness shows up perfectly in a story from his flying lessons. Ritchie's trying to land a small plane, and these insane wind gusts start throwing the plane all over the place. He fought the controls all the way down in what he called the worst landing ever in history. But his instructor was just blown away. So why?
Because, as the instructor explained, Any other beginner would have freaked out and handed the controls back. But Ritchie, even with all that chaos and fear, he stuck to the plan and landed the plane himself. And that's when he realized that was it. That was the one indispensable trait for a great trader, having the discipline and the guts to execute your plan when the market is screaming, the wind is howling, and every single instinct in your body is telling you to panic.
So all of this really boils down to 5 core rules. Number 1, do your own homework. After seeing so many scams, he learned to never trust anyone else's analysis. 2, trade small, so small that it almost feels like a waste of time. 3, be patient. Have the guts to hold a winning trade, sometimes for years. 4, let your profits run, which means you have to be okay with watching huge swings in your account. And finally, number 5, the most human challenge of all, you have to recognize and control your own greed.
But here's the thing. For Mark Ritchie, trading was never just about stacking up more and more money. Long after he'd made enough to live a dozen lifetimes, he kept at it with the exact same intensity. So why? Well, it's because that divinity student inside him had found a higher purpose for all the money being made in the chaos of the pits.
He actually hated the word charity. He thought it just created dependency. Instead, he believed in investing in the poor. The whole point wasn't to give handouts. It was to provide capital to create small businesses, to help people become self-sufficient. It was all about empowerment. He wanted to help build things so stable that one day they could even pay back his original investment.
And he lived by this really simple but powerful formula for all his income. About a third of it went to taxes. Another third got plowed right back into his trading account to keep it growing. And that final, crucial third, that was dedicated to all his projects, investing in the poor, everywhere from the Amazon jungle to his own neighborhood.
Okay, so we've followed his journey, we've seen his trials, we've learned his principles. You'd think a master of the game like Ritchie would end by encouraging everyone to follow in his footsteps, right? Well, his final word of advice is maybe the most surprising and revealing thing about him. There it is. After decades of unbelievable success, his advice is, don't even try. He basically said that a regular person trying to make a little extra money in the markets is like him trying to perform brain surgery on the weekends. It's a game for full-time, dedicated experts, and for anyone else to just dabble in it is a guaranteed way to lose your money.
And that leaves us with this one last, really deep question to chew on. Why would a man who completely mastered this world warn everyone else to stay away? Maybe it's because he, more than anyone, understood the brutal mental game, the iron emotional control you need, and the absolute necessity of being able to lose. Maybe the ultimate lesson from the divinity student who conquered the pits is that to win in the market, it isn't enough to know the strategies. First, you have to truly understand human nature, starting with your own.
Today, we are going to pull back the curtain on one of the most successful and honestly most mysterious traders you've probably never heard of, Joe Ritchie. He's the guy who founded the trading firm CRT, a powerhouse that just quietly took over some of the world's toughest markets. But here's the kicker. He didn't do it with a PhD from MIT or some secret algorithm. Nope. He did it with a degree in philosophy and a mindset so radical, so completely counterintuitive that most of Wall Street still doesn't get it. All right, let's get into this. And boom, right away, we run into the central puzzle of Joe Ritchie. Think about that for a second. This is a man who openly said his math education ended with high school algebra, yet people with doctorates in this stuff considered him a mathematical genius. You see, he didn't see math as a bunch of equations you had to solve on a blackboard. For him, it was like a language, a way to describe the world that he could actually feel. It wasn't about crunching the numbers. It was about understanding the deep underlying patterns of risk, chance, and what makes people tick. And that intuitive feeling, that's the key to his entire story.
So to really get how he built this incredible company, we're going to break it down into 5 key pieces. First, we'll get to know the man himself, this intuitive theoretician. Then we'll see how he found his first big edge. After that, we'll watch him take on the totally wild world of options pricing. Then we'll dig into what might be his most powerful secret weapon, his philosophy on people. And finally, we'll reveal what Ritchie himself called his truly unbeatable advantage. So who was this guy, this intuitive theoretician? Well, his firm, CRT, that stands for Chicago Research and Trading, it became legendary for its super sophisticated computer models. But Ritchie himself, he was the complete opposite of a numbers-first quant.
His real talent wasn't in writing code. It was in seeing the big picture. He could just look at a market and understand its architecture, how risk was flowing, and all the little psychological currents that were pushing prices around. And as we're about to find out, his intuition about people, well, that turned out to be the most valuable thing of all.
All right, so let's get into how he started. Richie didn't just show up on day one with some brilliant, complex new trading theory. Not at all. His journey began way more simply. He won by finding the little glitches in the system, the small, clunky inefficiencies that everybody else just ignored and wrote off as the cost of doing business. But he saw them differently. He saw them as pure opportunity.
And you got to put yourself in his shoes, right? He's starting out on the trading floor in Chicago, and it is absolute chaos. His team is this tiny little fish in a giant pond. They have almost no money compared to the big guys. They couldn't just throw money at the market or absorb huge losses. They were fighting an old boys club of established players with all the cash and all the connections. So if you can't win with brute force, what do? You have to win by being smarter.
The game they decided to play was arbitrage. It sounds fancy, but the idea is actually super simple. Imagine you see a book on sale for $10 in one store, and at that exact same second, it's selling for $10.05 in another store. Arbitrage is just the simple act of buying it for 10 and instantly selling it for 10.05, and you pocket that nickel. Now, a nickel is, well, it's basically nothing. But if you can do that thousands of times a day, those nickels add up to a fortune. And in this game, only one thing matters: speed. And this is what the old system actually looked like. I mean, it's kind of hard to believe, right? To make a single trade between New York and Chicago, a little light would start flashing on a phone. A broker in the trading pit would have to see it, literally sprint across the crowded floor to the phone, get the new price from a clerk in New York, and then sprint back into the yelling mob to execute the trade. It was physical, it was sweaty, and it was incredibly, incredibly slow. It was a system just waiting to be disrupted. And this is exactly where Richie found his opening. His competitors, even the good ones, took somewhere between 3 and 10 seconds to do that whole frantic dance. Richie looked at that process like an engineer. He hired top-notch clerks and paid them well, so his traders never had to leave the pit. He streamlined everything, the communication, the whole workflow, until he got the process down to a blistering 2 seconds. Now, a 1-second advantage might not sound like much, but in a world where prices vanish in a heartbeat, 1 second is an eternity. So what did that speed really get them? Well, it meant they could see and act on those tiny price differences before their competitors even knew they existed. They could work on razor-thin profits because they were doing so many more trades. While some big firm was lumbering through one huge order, Richie's team was darting in and out, hitting 10 smaller ones. They were like a swarm of piranhas in a tank full of sharks. And let me tell you, the sharks were not happy about it. They even tried to get them kicked off the exchange. So if you boil it all down, his early playbook was just brilliant in its simplicity. First, pay your people really well. He knew his clerks were his secret weapon for speed, so he paid them better than anyone. Second, build simple, smart tools. When he got into commodities, he literally made a custom slide rule to do complex calculations instantly. Third, be nimble. Don't fall in love with a market, just follow the opportunity. And the main rule tying it all together: perfect the mechanics. Win on execution first, then worry about the grand strategy. Okay, so he'd figured out how to win the speed game. But now he was looking for a much, much bigger challenge: the new, confusing, and incredibly complex world of options trading. This wasn't about speed anymore. This was a game of pure probability, of volatility, of time itself. And this is where his intuitive grasp of theory, shaped by one very painful lesson, would give CRT its next revolutionary edge. And this quote from him just says it all. It's better to be dumb and make a profit than be smart and take a loss. You know, this came from an experience that taught him that being the smartest guy in the room is one of the most dangerous things you can be in the market. He learned the hard way that sometimes your most brilliant idea leads you right off a cliff, and pure dumb luck can make you a fortune. You have to hear the story. It's absolutely insane. So based on what he thought was some really clever detective work, Richie gets convinced that a super powerful Saudi buyer is about to corner the silver market. So he loads up on a massive position of cheap options. Then, disaster. The buyer turns out to be a total fraud who wrote a $20 million bad check. Richie's smart trade is now completely worthless. He's crushed, so he just goes on vacation. But while he's gone, the infamous Hunt brothers actually start trying to corner the silver market, and the price goes to the moon.
Richie gets back to find that his worthless, dumb trade has somehow made an unbelievable amount of money. The lesson was burned into his brain. The market is way more random than you think. So that crazy silver trade taught him to be humble, and that humility let him see something that all the other geniuses were missing about how they priced options. See, everyone was using this model called Black-Scholes. It was brilliant, but it had this one huge flaw. It was built on the idea that prices move in a nice, neat bell curve. It basically said that huge market crashes or massive rallies were so rare they were almost impossible. But Richie knew from experience that crazy things happen in markets all the time. He understood the reality of what we call fat tails, that extreme events happen way more often than the models predict. And that right there, that became their secret weapon. While everybody else was using these models that were basically blind to huge risks, CRT's models were built to expect the unexpected. It was like other firms were selling fire insurance on houses, but their models told them houses never burned down, so they were selling the insurance way too cheap. CRT saw this mispricing, and for a long, long time, a huge chunk of their profit came from exploiting that one little crack in the academic theory. Okay, so we've covered speed, and we've covered theory. But if you could pin Joe Ritchie down and ask him what the real, lasting secret to CRT's success was, he wouldn't point to a computer. He wouldn't point to an equation. He would tell you it was all about the people. And his ideas on how to hire and manage them were maybe the most radical thing he ever did. Let's just look at how different their approach was. Your typical Wall Street firm, then and now, they're hunting for pedigrees. They're looking at your resume. Where'd you go to school? What's your PhD in? They hire resumes. CRT was different. They hired human beings. Yeah, you had to be smart, obviously, but what they cared about most was your character and how you were going to fit in and work with the team. And this quote from one of his top guys, Gene Frost, just says it all. They learned this lesson the hard way, too. They once hired this certified genius, a world champion of the board game Go. But after he made one bad trade, the guy panicked. He hid his mistake from the team, and he turned a small loss into a $100,000 disaster. They fired him on the spot. The lesson was crystal clear. A person with great character who you can trust is worth way more than some fragile genius you can't. So out of that experience, they built this incredible people formula. First, only hire real team players, people who get just as excited about the group winning as they do about their own success. Second, empower them 100%. Give them huge responsibility and then trust them to be their own toughest boss. Third, they believed the best traders were instinctive and humble, not guys who get paralyzed trying to overanalyze everything. And finally, if you hire someone with great character and they don't work out in that first job, you don't just fire them. You work like crazy to find another spot in the company where they can thrive. And look, this wasn't some feel-good HR program. This was a profit-making strategy. You can see it right here in this quote from one of their traders. When you know deep down that your boss trusts you completely, you lose the fear of making a mistake. You're not scared to take a smart, calculated risk with the company's money. You're not afraid to raise your hand and say, I messed up when a problem is still small. That psychological safety that comes from total trust, it was like a performance-enhancing drug that no competitor could ever copy. Which brings us to the final piece of the puzzle, the big reveal. After peeling back all these layers, the speed, the theory, the culture, what was the one thing, the real secret sauce, that truly made CRT unbeatable? You know, for years, everyone on the outside was obsessed with this idea that CRT had a secret black box. They were just convinced there was some hidden algorithm, some magical computer humming away in a basement somewhere that was just printing money. And honestly, Richie was happy to let them chase that ghost, because the truth was so much simpler, so much more human, and infinitely harder to copy. And here it is. This is the whole game, straight from the man himself. He said his secret was just building teams of high-character people, giving them total authority, and then trusting them. That's it. And he knew he could shout this from the rooftops because, first, his competitors just wouldn't believe him. It sounds too easy, too soft. They wanted a technical answer. And second, even if they did believe him, the top-down need-to-be-in-control mindset is so baked into most leaders that they are psychologically incapable of actually doing it, of truly letting go and trusting their people completely. The original book this is based on ends with that question, and it's the one I want to leave with you today. In a world that is constantly chasing the next piece of tech, the next data-driven edge, the story of Joe Ritchie is this powerful reminder. It makes you wonder if maybe the greatest competitive advantage of all, the most radical and truly unbeatable edge, isn't something you can find in a spreadsheet or in an algorithm, but in a deeply human philosophy of trust.
What in the world does a high-stakes blackjack table in Las Vegas have to do with the chaos of the Wall Street trading floor? You'd probably think it's all just one big gamble, right? A roll of the dice. But for a guy named Blair Hull, the casino was actually his training ground for the market. So, let's dive into this incredible story of how a professional card counter used his skills to build a financial empire. And that brings us to the big question, the one that's at the heart of this whole thing. Is what happens on Wall Street really just a fancier, more sophisticated version of what happens in Vegas? Is it all just a gamble? Well, Blair Hull's journey gives us a pretty powerful answer. And right away, Hull gives us his answer. And it's a hard no. For him, winning consistently, whether you're at a card table or a trading desk, has nothing to do with luck. It's all about having a solid, logical strategy and the ironclad discipline to stick with it, no matter what. So how did he even get to this way of thinking? Well, it's interesting. He didn't start on Wall Street. Actually, his journey began when he walked away from it, which led him down a very, very different path. Okay, picture this. It's 1969, and Hull is a security analyst. But he gets frustrated, fast. He feels like the way everyone else is analyzing companies, fundamental analysis, is just too subjective, too much guesswork. Then, in 1971, he reads a book that completely changes his life. Ed Thorp's Beat the Dealer. And boom, that's the light bulb moment. He starts playing blackjack, not for fun, but as a mathematical problem to be solved. By 75, he's a full-blown pro on a card counting team. And just a year later, he takes everything he learned about probability at the casino and heads right back to the markets. So if we're going to understand how he beat the markets, we first have to understand exactly how he learned to beat the casino. And listen, this wasn't about catching a lucky streak. It was about systematically finding and then exploiting a small mathematical advantage, what pros call the edge. So what is this edge? Well, in blackjack, the casino usually has a slight advantage. But here's the thing, that can flip. When a bunch of small cards have already been played, the rest of the deck becomes loaded with high cards, tens and aces. When that happens, the odds actually shift into the player's favor by a tiny but crucial 1 or 2%. The whole game is just knowing exactly when that shift happens. So how did they know? Hull's team used a pretty complex system called the Revere method. It was all math, zero emotion. First, they gave every card a point value. Small cards were positive points, high cards were negative. As the dealer laid out the cards, they'd keep a running total in their heads, the raw count. But here's the secret sauce. They'd calculate the true count by dividing that raw count by the number of decks left in the shoe. That told them the density of high cards. And the rule was simple. When the true count was high, you bet big. When it was low, you bet the minimum, or just walked away. Now, Hull figured out pretty quickly that going it alone had its limits. Playing on a team was a total game changer. First, they could pool their money to make way bigger bets when the odds were in their favor. Second, and this is so important, it let them play thousands and thousands of hands. See, if you have an edge, the law of large numbers means that the more you play, the closer your results will get to your mathematical expectation. It basically turns a probability into a certainty over time. Plus, it made them way harder for the casinos to spot. They had counters at different tables, quietly keeping track, and when the count got hot, they'd signal a big player to come in and make the large bets. Genius. Of course, the casinos eventually started getting wise to his team, and Hull needed a new playground. So, he turned his sights to the options market. He realized the exact same principles applied. This was the moment he went from trying to beat the house to becoming the house. And the results? I mean, they were just insane. He started with a stake of $25,000 in late 1976. By early 1979, a little over 2 years later, he had turned that into 20 times the original amount. That wasn't a lucky streak. That was proof that his system worked just as well on a trading floor as it did at a blackjack table. So how'd he do it? What was his new card counting method? Well, it all boiled down to an idea called theoretical value. He built a computer model that would calculate what the price of an option should be based on stuff like the stock's price and its volatility. That gave him a baseline, a fair price. His edge was simply finding options that were trading for more or less than that value. And the beauty of his method was its simplicity. He wasn't trying to guess if the whole market was going up or down. Nope. He was just looking for tiny mispricings. For the same stock, he'd find an option that was cheap compared to its theoretical value and buy it, while at the same time selling another option that was too expensive. It's the exact same logic as blackjack. You only place your bet when you know you have a quantifiable edge.
And even years later, after building this massive, legendary trading firm, Hull said the core idea never really changed. It always came back to that one powerful principle. Use a logical model to find out what something's worth, then buy it when it's cheap and sell it when it's expensive. And what started as this one-man show quickly grew into an absolute force in the markets. Hull Trading Company took the principles he perfected and just scaled them up to an unbelievable level. I mean, just get a load of these numbers. The firm kicked off with $1 million in 1985. By mid-1991, just 6 years on, that had ballooned to $90 million after all expenses. And their gross profits over that time, a mind-boggling $137 million. This wasn't just successful trading, this was building a literal money-making machine. So how on earth did they manage all of this? The answer was tech. Pure, raw computing power. Hull Trading had an entire floor of their building packed with computers. At any given moment, their system would recalculate the firm's total risk across every single position, every 2 seconds. They even had one trader whose only job was to be the air traffic controller, constantly hedging the firm's overall risk to keep it as close to neutral as possible. And with that tech advantage, they became, well, a monster in the market. At their peak, they weren't just another player. In some options markets, they accounted for over 10% of the entire trading volume. Think about that. They had become a fundamental piece of the market's plumbing, providing massive amounts of liquidity. In effect, they had become the house. All right, so what are the big lessons here? What can we actually learn from this wild ride from the Vegas Strip to Wall Street? Well, Hull's career basically gives us a clear blueprint for navigating any kind of uncertain environment. Let's break down his core rules. First, and this is non-negotiable, you must have a logical method that gives you an edge. Second, you have to be a robot. Control your emotions, ignore the news, ignore the rumors. Third, you gotta have faith in your system, especially when you're losing, because you will have losing streaks. Fourth, and this one is huge, strict risk control. His rule was brilliant in its simplicity. If you lose half your stake, you cut your trading size in half, period. And finally, play the long game. Go for a ton of small, consistent wins, not a few wild home runs. And he really walked the walk. Most of the time, he was making those small, relative value trades. But a few times a year, he'd make a big bet on the direction of the market. And his signal? The absolute peak of public fear. When DC-10s were crashing and everyone was panicking that the planes would be grounded forever, he bought call options on the company. During the 1987 crash, as the market was literally halted from the panic, he stepped in and bought S&P futures, catching the exact bottom of the day. And on the morning of the Gulf War deadline, when the whole world was braced for a collapse, he went long. He was the ultimate contrarian. So this brings us right back to where we started, to that fundamental difference at the core of everything Hull did, the massive gap between just gambling and actually having an edge. Let's just lay it out side by side. Gambling is random. It doesn't have a real method. Trading with an edge requires one. For a gambler, the longer you play, the more certain you are to lose. For a trader with an edge, the longer you play, the more certain you are to win. Gambling is driven by feelings, hope, fear, hot tips. Trading with an edge is driven by cold, hard strategy and discipline. A gambler is making a bet against the house. Blair Hull's entire career was about one thing, becoming the house. And this, right here, might be the single most important takeaway from his entire story. It's so blunt, but it's true. A gut feeling is not a method. A tip from your buddy is not a method. If you can't write down on paper exactly what your repeatable advantage is, you don't have one. You know, in the end, a casino can kick you out for winning too much. But the market can't. It doesn't bar skillful players. The opportunity is always there. So the real barrier isn't out there, it's in here. And the final question isn't whether it's possible to beat the market. The real question is much more personal. Do you know what your edge is?
All right, welcome to The Explainer. Today, we're going to try and get inside the mind of a trading legend, Jeff Yass, and break down his core philosophy, the mathematics of strategy. We're going to see how he uses principles from games, like poker, to navigate the wild complexities of financial markets.
So right off the bat, Yass just completely reframes the whole conversation. For him, the market isn't some boring spreadsheet with numbers. No way. It's a living, breathing game table, a contest of skill, of psychology, and maybe most importantly, of probability.
a game where knowing who you're playing against is every bit as important as the cards you're holding in your hand.
So let's really unpack this poker analogy. For Yas, this isn't about pulling off some great bluff or getting a lucky draw. It's about something way deeper, a core principle of competition. You don't actually have to be the best player in the world to win big.
And Yas has this perfect analogy for it. Think about it. Let's say you're the 6th best poker player on the entire planet. If you sit down at a table with the top 5 players, what's going to happen? You're going to lose. Every time. It's a guarantee. But what if you're just an okay, average player, and you find a game full of people who are, well, not very good? You're going to win. It's all relative. It's the context of the game and the skill of your opponents that really defines your strategy.
This brings us to our first puzzle, and it's a concept that just flips conventional wisdom on its head. See, most people think the goal is to win as often as possible, but Yas argues that this is a fundamental and honestly a very costly mistake.
Okay, so think about this for a second. The last card's on the table. You know for a fact you have the winning hand, the unbeatable hand. What's your immediate impulse? For most people, it's to bet, right? Lock in that profit, take the sure thing. But hold on a second. Is that really the best move you can make? The most profitable one?
And this is where you see the split, right? The novice, well, they're going to bet right away. They guarantee a small win and they're happy. But the expert, they play the long game. They check. Now why? Why would they do that? Because they're thinking, if there's a good chance my opponent will bet, I can then raise them and win double. It's a calculated risk. You sacrifice a tiny, certain win for a really good shot at a much, much bigger pot.
And that, right there, is the heart of the lesson. Look, it's not about racking up the most wins. It's not about your win-loss ratio. It's about maximizing your winnings over the long haul. Sometimes you've got to pass up that small guaranteed profit to set yourself up for a larger, more probable one down the road. That focus is the real secret.
Okay, let's move on to puzzle number 2. And this one gets even deeper. This isn't just about maximizing your profit. It's about reading the actions of other people, especially when you have a nagging suspicion that they might know something you don't.
All right, another scenario for you. You're playing 7-card stud. You're holding 4 aces. I mean, that's an incredible hand, right? One of the best you can get. But then your opponent, who can see your 4 aces plain as day, makes this huge, massive bet. Your first instinct might be pure excitement. You're about to clean up. But their action is a brand new piece of information, and you absolutely cannot ignore it. The expert player's alarm bells are going off immediately. They're thinking, wait a minute. Why on earth would they bet into my 4 aces? There's only one reason, and that reason is they have the one hand that can beat it, a straight flush. In this situation, you actually can't win anything more by betting, because if they have a weaker hand, they'll just fold. You can only lose more if they have that monster hand. Their bet is a signal. It's telling you to get out.
And what this is a perfect example of conditional probability. The odds you started with, hey, I've got 4 aces, I can't lose, they're completely out the window because of this new piece of information, their huge bet. The probability of you winning after that bet has just plummeted. And that's a lesson Yas takes straight to the trading floor.
All right, now for the master key that really unlocks this whole way of thinking. It's a classic puzzle that pits your raw gut feeling against cold, hard mathematics. The famous Monty Hall problem from the old game show Let's Make a Deal. Okay, so let's walk through this because the details here are absolutely crucial. You've got 3 doors. Behind one, there's a car. Behind the other 2, goats. You pick a door, let's say door number 1. Now here is the most important part of the puzzle, so listen close. The host, Monty Hall, he knows where the car is, and he opens one of the other doors, say door number 2, to show you a goat. He will always show you a goat. Then he turns to you and asks, do you want to switch to door number 3?
So what do? I mean, your gut is screaming at you. It's 50-50 now. There are 2 doors left. It doesn't matter, right? It just feels like a simple coin flip. Well, that feeling, it's totally, completely wrong.
The math is crystal clear on this. You should always switch, every single time. It's not a small difference either. By switching, you literally double your chances of winning the car. It's not 50-50 at all.
So why? How does that work? Let's break it down. When you first picked your door, you had a 1 in 3 chance of being right. Simple enough. That means there was a 2 in 3 chance that the car was behind one of the other 2 doors. Now, when the host opens one of those other doors to show you a goat, he's not changing those initial odds. He's giving you new information. He's basically taking that entire 2/3 probability and concentrating it all on that one other door he left closed. Your door is still 1/3, the other door is now 2/3.
So you're probably sitting there thinking, okay, a quirky game show puzzle. What on earth does this have to do with the fast-paced, high-stakes world of financial markets? Well, the answer is that it's all about understanding these hidden probabilities and learning to question the obvious.
Well, it leads us to this really interesting real-world concept called skewness in options pricing. Basically, the market consistently prices insurance against a big crash, we call those puts, as way more expensive than bets on a big rally, those are calls. And why is that? It's simple human psychology, fear. As a group, people are way more scared of a sudden crash than they are hopeful for a sudden euphoric boom. That fear is skewed to the downside.
And Yas figured this out super early. He saw that the traders who just blindly followed a pure math model, the ones who said, hey, these puts are technically overpriced, they kept losing money. They'd get crushed. Why? Because they were selling that overpriced insurance to traders who used common sense and knew that, yeah, crashes actually happen. The seat of the pants traders beat the pure math types because they understood the real-world fear that was driving the prices.
And all of this, it all leads to Jeff Yass's ultimate philosophy. And honestly, it's one that requires a ton of intellectual humility and a really deep respect for the collective intelligence of the market.
You know, this is a really radical idea, especially in a world filled with huge egos. Instead of trying to be the smartest guy in the room and outsmart everyone, Yass does the exact opposite. He listens to the market. He believes the price of something, which is set by the actions of millions of people, is the best indicator of its true value. Trying to fight that collective wisdom with your own little opinion is, in his view, just a recipe for disaster.
So what are the big takeaways from all this? First, respect the market price. It's probably smarter than you are. Second, always be wary of your own intuition. If a bet seems too easy or too good to be true, you are probably missing a key piece of information. And third, the most practical advice of all, always protect yourself by diversifying your investments. And Yass doesn't mince words on this one. He says that if you invest and you don't diversify, you're literally just throwing money away. It's like setting a pile of your own cash on fire every single year. The magic of it is that diversification lowers your risk way more than it lowers your potential return. It is the closest thing to a free lunch you will ever find in finance.
And that kind of leaves us with this final, really provocative thought. In a field that is completely dominated by big egos and bold predictions, a world obsessed with being right, maybe the greatest competitive advantage isn't in claiming to have all the answers. Perhaps, as Jeff Yass shows us, the real edge comes from respecting the puzzle, listening to the wisdom of the crowd, and just having the humility to admit what you don't know.
Today, we're diving into a really fascinating and frankly kind of weird idea. What if the secret to making a fortune in the chaotic world of finance has nothing to do with algorithms or data, but with ancient Zen philosophy? Yeah, we're talking about the art of making millions of dollars by, well, not trying.
I mean, this question just flies in the face of everything we're taught, right? We're told you need discipline, complex systems, endless data analysis. But what if there's another way? A path that's all about intuition, impulse, and a mindset that seems like the total opposite of Wall Street, but somehow is ridiculously successful.
And get this, these are the actual words from the trader at the heart of this story. This is a guy who pulled in mind-boggling profits for his firm, but when you ask him how, he can't point to a single chart or a rule book. He says his secret was something else. So, to really wrap our heads around this, we're going to break it down. First, we'll look at this baffling impulsive method. Then, we'll get into how he finds what he calls the market's rhythm. We're going to unpack the Zen philosophy behind it all, figure out the difference between real intuition and just wishful thinking, and then, you're going to love this, we'll see a wild real-world example of it in action. All right, let's start with the man himself, the impulsive millionaire. We need to try and understand a method that, on the surface, just seems to defy all logic. But, as you're about to see, you can't really argue with the results. And here are those results. We're talking more than $200 million in profit. This isn't a one-off lucky bet. This is the kind of consistent, massive success that basically forces you to take a closer look, no matter how strange the method sounds.
You have to understand, it wasn't just that he didn't have a complicated system, he had no system at all. His entire process was just raw impulse. If he felt like the market is going up, he'd buy. If he got a sense that it's gone up enough, he'd sell. This wasn't laziness, it was his philosophy. Trust the feeling, right here, right now.
Okay, so what happens when that feeling goes away? Because let's be real, it's not always going to be there, even for the best. Well, this trader had a super simple, almost elegant rule for knowing when he was out of tune with the market, and more importantly, how he got back in.
And this is a really key idea. See, he doesn't view the market as just a bunch of numbers on a screen. To him, it's something alive, something with a pulse, a rhythm. The goal isn't to outsmart it or predict it. The goal is to just get in sync with it.
And his method for doing that is just brilliant. Think of it like a safety switch. The rule is simple. If he gets 3 trades wrong in a row, that's it. He's done. He immediately stops trading with real money, switches over to just practicing on paper, and he stays on the sidelines until he feels that rhythm, that intuitive connection come back.
Okay, so now we get to the heart of it all, because this whole approach is tied to a much bigger, much older idea. This is where we really start to see what Zen and the art of trading is all about.
His whole philosophy comes from this classic book, Zen and the Art of Archery. And the main point of the book is that true mastery isn't about trying harder or focusing more. It's about the exact opposite. It's about getting your conscious self, your ego, to just get out of the way and let the perfect shot happen through you.
And you can feel the difference, right? On one hand, you have the ego-driven action, where the inner voice is saying, I am shooting this arrow. It's full of effort, straining, trying to force it. Then you have the Zen action, where the thinking is passive, the arrow is shot, the self is just gone, and the action is pure.
So he takes that exact same logic and applies it to the market. When you're struggling with a trade, stressing about it, trying to will it into being profitable, that's your ego, and it's a giant red flag that you're out of sync. The perfect trade, the Zen trade, feels like nothing. It's like the trade is just happening through you. It's totally objective and totally effortless.
So this obviously leads us to the biggest question of all. If this is all based on feeling, how in the world do you tell the difference between a true, deep intuition and just your ego, desperately wanting a trade to work out?
And the trader himself says that this distinction is everything. Your ego wants the market to go up because you're long. Your ego wants that losing stock to turn around. But true intuition, it doesn't want anything. It just knows. And the real art is learning to listen to that much quieter voice.
Let's just put it side by side. The ego, the wanting, it feels like effort, like force, like you're straining. That's how you know you're out of harmony, and it almost always leads to a bad trade. But intuition, the knowing, it feels like a calm, objective awareness. It's effortless. That's when you're in sync, and that's when the perfect trade just happens. Now, I know this can all sound a little abstract, so let's look at a concrete and kind of mind-blowing story that shows this deep intuition literally forcing its way to the surface.
Okay, so picture this. Our trader is on the phone with another trader, and they're talking about the exchange rate between the Japanese yen and the German mark. And the current price is sitting right at 87.80. Remember that number, 87.80.
So as they're talking, he keeps making this weird mistake. Instead of saying the correct price, 87.80, he keeps saying 77.80 over and over again, a full 10 points lower. He does it so many times that the guy on the other end of the line finally stops him and says, "Dude, what are you talking about?"
And of course, that's what we call a Freudian slip, right? It's that moment when your unconscious mind kind of blurts out the truth, revealing something you didn't even know you were thinking.
And right then, it hit him. This wasn't just a random slip-up. He realized that some deep part of his mind, his intuition that was already in sync with the market, knew that the rate was going to fall all the way down to that level. His conviction was so strong that, in his words, it was literally bubbling out of him. That was the only signal he needed.
So let's tie all of this together. What is the one core lesson we can take away from this whole incredible philosophy of trading? It all comes back to this one powerful sentence. In trading, just like in archery, the second you feel yourself trying, the second you feel that struggle, that strain, that's your signal. That's your alarm bell telling you that your ego has taken over, you're out of sync, and you're probably about to make a mistake. And that just leaves us with this one big question to chew on. We live in this age of AI, of high-frequency trading, where we try to boil everything down to data and algorithms. So in a world like that, what's the real value of something you can't quantify? What is the true value of a gut feeling?
Welcome to The Explainer. Today, we're going to crack open the mental blueprint of top performers, all thanks to the work of Charles Faulkner. We're going to dive into how they think, what really drives them, and most importantly, how you can start using their strategies in your own life.
Okay, let's just start with a pretty wild question. What if you could literally install the mental software of a top achiever directly into your own brain? I mean, imagine being able to download the mindset of a world-class athlete or a brilliant entrepreneur. Well, believe it or not, that's pretty much the promise of a field called neuro-linguistic programming. You've probably heard it called NLP. It's a really powerful and practical way to think about personal development that's all about modeling what actually works. So what is it exactly? Well, NLP is basically the study of human excellence. Instead of getting bogged down in theory, its creators went out and studied people who were just exceptional at what they did to figure out the specific mental programs they were running to get those incredible results. And Charles Faulkner has this fantastic way of describing it. He calls NLP software for the brain. Just think about that. It's like a set of mental programs you can install to build new skills and start having more of the experiences you actually want in life. To really get this, think about learning to ski. You know, before the 1950s, most people thought being a good skier was just some kind of natural talent. You either had it or you didn't. But then, some clever people filmed the best skiers in Europe, slowed it all down, and broke down exactly what they were doing. They created a model. And just like that, skiing became a skill that almost anyone could learn because the talent was now a process. NLP does that, but for everything else. Okay, so if NLP is the software, what's the operating system it runs on? Well, it's guided by 5 core principles. You can think of these as the fundamental rules in the user manual for your mind. At its very heart, NLP is built on 5 foundational ideas, or presuppositions as they're sometimes called. These are the core assumptions that make the whole system click. All right, here they are at a glance. First, the map is not the territory. Second, and this is a cool one, experience has a structure. Third is the one that gets everyone excited. If one person can do it, anyone can learn it. Fourth, mind and body are part of the same system. And finally, this really empowering belief. People have all the resources they need. So let's unpack these. Let's start with the map is not the territory. This is absolutely huge. It means that we're never actually reacting to reality itself. We're reacting to our internal map of reality, our thoughts, our beliefs. I mean, that's why 2 people can see the exact same thing happen and have completely different reactions. And the best part? You might not be able to change reality, but you can always change your map. You can always find a better one. Next up, experience has a structure. This is a real game changer. It means our memories aren't just these fixed things we replay. They're actually built out of specific sights, sounds, and feelings. And if you change the structure, how you organize that memory in your mind, you can literally change how it makes you feel, right here and now. This quote right here perfectly captures that 4th principle, that your mind and body are one system. They aren't separate things. They're constantly influencing each other. And it's so powerful. Change your thoughts and your posture changes. But it also works the other way. Change your posture, stand up tall, and your thoughts can change instantly. It's a 2-way street that gives you incredible leverage over your own state. Okay, so that's the theory, but how do we actually do this stuff? This is where that other principle comes in, that if someone can do it, we can learn it. So let's get practical and look at a couple of techniques. These are actual models you can use to start rewiring your own brain, like today. All right, here's a really cool exercise Faulkner calls an emotional reset button. Think of a memory that kind of bugs you. Got one? Okay. First, freeze it. Turn it into a still photograph in your mind. Now, this is the magic part. Zoom out from that photo until you can see your younger self in the picture. You're now an observer. Then, for fun, repaint it in your mind in the style of, say, Van Gogh, and then put a giant, silly, ornate frame around it. What you'll probably find is the emotional sting is just gone. You changed the structure and the feeling followed. Okay, how about we install a positive feeling you can access anytime you want? This is called the circle of confidence, and it's based on that awesome principle that you already have all the resources you need. So first, think of a time when you felt totally, completely confident. Really go there. Feel what it felt like. Now, as that feeling gets stronger, imagine a colored circle of light on the floor all around you, just soaking up that confident energy. Then, take a step out of the circle. Now, think of a situation in the future where you'd love to have that confidence. As you picture it clearly, step back into the circle. Boom. You've just taken a resource from your past and linked it to your future. So we have these amazing tools to change how we feel in a moment. But what about the long game? What is the fuel that keeps us pushing toward our goals? This brings us to a really fascinating idea in NLP, the two faces of motivation. Turns out, our drive comes in two very different flavors. So on one hand, you've got toward motivation. This is your classic go-getter. They're pulled forward by the promise of pleasure, rewards, and achieving their goals. Then you have away from motivation. This is the person who's driven to move away from problems, pain, and negative stuff. They're the ones who finally get to work when the fear of missing the deadline becomes overwhelming. Now, neither is good or bad. Toward people are amazing at setting goals, but away from people are fantastic at spotting problems and managing risk. So here's the key insight. Which one is better? It's a trick question. The answer is top performers don't choose one or the other. They use both. They have that exciting toward goal that pulls them forward, but they also use that away from thinking to spot potential problems and protect themselves. They harness the full spectrum of motivation. All right, so this brings us to the blueprint itself. This is where we put all the pieces together into a plan you can actually use. What are the specific conditions, the essential characteristics that pave the road to success? Well, according to all the NLP research, for a goal to really have a shot, it needs to meet 5 conditions. First, you have to state it in positive terms, what you want, not what you want to avoid. Second, it has to be your goal, not something your parents or society wants for you. It's got to be specific and vivid. You need to know the context, when, where, who with. And finally, you have to think it through. What will happen when you get it? Is it really worth it? And what about your mindset? Faulkner shares this incredible model they discovered by studying athletes who made these unbelievable recoveries from catastrophic injuries. They all shared 6 things in common. They used both toward and away from motivation. They were absolutely committed to a full recovery, nothing less. They broke the huge goal down into tiny steps and celebrated every single one. They focused only on the present moment. They were active participants in their own recovery. And this last one is so important. They only compared themselves to themselves. How am I doing today compared to last week? That's it. No looking at what others were doing. All of these tools, these mindsets, they're incredibly powerful. But what are they for? What's the point of it all? And that brings us to our final section, which is really the ultimate goal here, living a life without regret. This whole idea comes from a really profound experience Charles Faulkner had. He was working in a hospital and he talked with hundreds of people who knew they were near the end of their lives. He asked them about their regrets, and the answer he got back was shockingly consistent. It wasn't the mistakes they'd made. It wasn't the things they tried that failed. Their deepest, most painful regret was for the things they hadn't done, the chances they didn't take. They felt they had wasted their precious time on small stuff, instead of figuring out what was truly important to them, their core values, and then going after that with everything they had. And so this whole journey into the mind of an achiever, all these tools and techniques, it really all boils down to this one final question. It's the question you have to ask yourself. When you clear away all the noise, all the expectations, what is really, truly worth the time of your life? You know that feeling, right? When you know exactly what you're supposed to do, you've got the perfect plan laid out, but you just find yourself frozen, totally unable to act. Well, for anyone in a high-stakes game, traders, athletes, you name it, that hesitation, that's everything. It's the difference between winning and losing. Today, we're diving into the work of a fascinating man named Robert Cross. He believed the biggest, most important battlefield isn't out there in the world. It's right between your own ears. So let's get into his incredible story and the powerful lessons he learned the hard way. I mean, just look at this life. Long before Robert Cross ever even saw a price chart, his entire existence was a masterclass in survival and resilience. We're talking about surviving a ghetto in World War II, escaping a death march when he was only 8 years old, then serving as an Israeli paratrooper, and then becoming a star fashion designer in the swinging 60s in London. Seriously, any one of those chapters could be its own movie. But for Krause, all of that was just the warm-up for his ultimate challenge, figuring out how to conquer the markets and, more importantly, how to conquer himself. All right, so here's our game plan for today. We're going to follow his wild journey into trading, and then we'll get into the first really painful lesson the market taught him. We'll see how that disaster actually led him to a huge discovery about the subconscious mind. Then we'll dig into the psychology of why we lose, how you can actually rewrite your own inner script for success, and finally, we'll cover the one thing that Krauss said is the absolute non-negotiable foundation for winning. So Krauss didn't just dip his toes into trading. No, he went all in. He completely uprooted his life, left his super successful business behind, and moved to the US just to dedicate himself to this full-time. So what was it about the markets that just grabbed him so completely? Well, this quote says it all. After a life filled with chaos and so many gray areas, what he loved about trading was how brutally honest it was. It's black and white. You're either right or you're wrong. There's no office politics, no one to blame, no excuses. It's just you versus the market. And for him, that absolute clarity was the ultimate challenge, a pure test of his own skill. But that brutal honesty can be, well, brutal. Krauss got his first taste of the action during the massive gold bull market back in '79. He had a friend who was just raking it in, making it look so easy, and of course Krauss thought, hey, I can do that. So he opened an account ready to take on this new world. And then what Krauss himself called the greatest tragedy happened. His very first trade was a huge win. And if you know anything about trading, you know this is the classic trap. It feels like you've cracked the code on day one. You feel like a genius, like you're invincible. And the streak kept going. His second trade was a winner. The third was a wash, but then his fourth trade, another big score. His confidence was just through the roof. In his own mind, he wasn't just some businessman trying out a new hobby anymore. No, he was a brilliant trader. And the market just kept reinforcing that dangerous idea. And then, bam, the market delivered its lesson. On trade number 6, the bottom fell out. And it was devastating. He didn't just lose all his winnings, he lost way more. He got hit with margin calls, kept throwing more money at it, absolutely convinced it would turn around. It didn't. Now, the financial loss was bad, for sure, but the damage to his ego? Krauss said that was way, way worse. Here was a guy who had succeeded at everything he'd ever tried, and he had just been proven spectacularly wrong. Now, most people would have just walked away, right? Licked their wounds and quit. But Krauss wasn't most people. He took it as a personal challenge. He decided he was either going to figure out what really makes the market tick, or he was done for good. So he went on this intense journey of study and actually developed a new technical methodology. But he quickly realized that having a new strategy wasn't enough. You see, he had this new system that he logically, consciously trusted. He knew it worked, but when the time came to actually place a trade, he would freeze. He just couldn't pull the trigger. It's like his hand was on the mouse. He knew he had to click, but his body just wouldn't let him. His mentor called it the freeze and told him, Robert, that's not a technical problem. That's a psychological one. And this is the war that was raging inside his head. On one side, you have the logical, conscious mind, saying, hey, we've back-tested this. The plan is solid. This trade makes sense. But on the other side, his subconscious, the part of our brain that holds on to deep, powerful emotions, was screaming a totally different message. It just remembered the pain and the humiliation from that huge loss, and its only job is to protect him from ever feeling that way again, even if it means sabotaging his own success. The breakthrough came from the most random place imaginable. He literally just bumped into an old acquaintance who told him he turned his own life around using hypnotherapy. Now, Krauss was skeptical, to say the least, but he was also desperate, so he gave it a shot. And guess what? It worked. The freeze was gone. But it did so much more than that. It completely opened his eyes to this powerful, invisible force he never even knew was running the show, the subconscious mind. And this discovery basically became his life's work. He realized that to be a consistent winner, a good strategy is just table stakes. It's not enough. Your conscious goals, what you say you want, have to be in perfect alignment with your subconscious beliefs. Because if they're not, if they're fighting each other, the subconscious is going to win. Every single time. And this is the absolute core of his whole philosophy. It's not about wanting to win. Come on, everyone wants to win. It's about a deep down fundamental belief that you deserve to win. Because if, for whatever reason, your subconscious has this old story that you're not good enough or that you need to be punished for something, it will find a way to make you lose. It'll make you sabotage yourself, no matter how good your trading plan is. Krauss saw this kind of self-sabotage over and over again, and he tells this wild story as an example. A guy comes to him for help, and his problem is that he never gets his brokerage statements in the mail. He's convinced his wife is intercepting them from the mailman every single day. The question is, why on earth would she do that? So Krauss calls the wife, and she's like, "What are you talking about? I never touch his mail." In fact, she tells him he hides them himself. He gets them, and then he never opens them. So now the plot thickens, right? The guy is obviously hiding something, but from who? Krauss figures the only way to get to the bottom of it is to put the husband under hypnosis. And there it is, the truth. Under hypnosis, the trader just spills it. Krauss asks him what happens to the statements, and he says, "Oh, I hide them, of course." And when he's asked why, he says, "I don't want to see my mistakes." Isn't that incredible? Consciously, he loved the action and the thrill of trading. But subconsciously, he could not bear to face the reality of his own losses. He was literally making up a story and blaming his wife to avoid the pain of confronting his own errors. Okay, so if our subconscious mind is running on this old, buggy software that's causing us to sabotage our best efforts, what in the world can we do about it? Well, the answer isn't to fight it. It's to rewrite the script. You have to actively go in and reprogram those old, outdated beliefs. And Krauss laid out a pretty clear process for how to do this. First, you use deep relaxation, or hypnosis, to kind of bypass the critical, logical part of your brain. You know, the gatekeeper. This lets you talk directly to the subconscious, which is totally non-judgmental. It just accepts what it's told. Then you tell it, "Hey, those old fears, the ones from that big loss years ago, they're not relevant anymore. We're safe now." And finally, you use creative visualization to paint these really vivid, new mental pictures of yourself succeeding, feeling confident, and winning. You're literally replacing the old disaster movies with new highlight reels. Now, this next part is maybe the most important takeaway of all. All the psychological work in the world is completely useless if you haven't done the actual hard work first. You can't use hypnosis to turn a beginner chess player into a grandmaster, and you can't use it to make someone with no trading plan a winning trader. Psychology is the final, crucial piece of the puzzle, but it absolutely has to be built on a solid foundation. Check this out. In one of his workshops, Krauss asked 30 traders to write down their biggest weaknesses. And what he found was incredible. 90% of them listed the exact same 4 things, just maybe in a different order. Lack of confidence, no trading plan, poor execution, which is just another word for the freeze, and a fear of loss. Do you see the pattern here? Krauss argued that 3 of those are just smoke. They're symptoms. What's the real disease? It's right there, having no trading plan. Think about it. If you don't have a plan that you've tested, that you trust, of course you're going to be afraid. Of course you're going to lack confidence and hesitate. You're not trading, you're just gambling. And that leads directly to this, the bedrock. Krauss's 5 non-negotiable tasks that every single serious trader has to do. You have to develop a solid methodology. You have to create a specific, reasonable plan from it. You have to build clear rules, including money management. And this next one is the key. You have to backtest that plan relentlessly until your conscious mind is 100% convinced that it has an edge. Only then, once that foundation is built, can you really start to work on the final step, the self-management, to actually follow the plan. And that's where all the psychological work comes in. So that's really what it all boils down to. You can have the most brilliant, logical, well-tested strategy in the entire world, but whether you succeed or fail might just depend on a much deeper question. What's the story that your subconscious is telling itself? Is it a story of fear and not being good enough, based on some old wound from years ago? Or is it a story about a confident, disciplined winner who deserves success? Because as Robert Krauss's incredible life shows us, in the end, we become what we truly believe we are.
Welcome to The Explainer. Today, we're going to try and crack open the minds of the world's greatest traders. You know, the ones they call market wizards. We're going to distill decades of their hard-won experience to uncover the core principles that really separate them from everyone else.
You know, it's a question that has to fascinate anyone who's ever stared at a market chart. And the answer? Well, it's not some secret indicator or a magic formula. Turns out it's a powerful combination of 3 things: a very specific mindset, a repeatable strategy, and a deep, sometimes brutally honest understanding of themselves.
So, let's just dive right in. What we've done is boil down 42 core rules for success from these absolute masters, and we've organized it into a kind of journey. We're going to cover everything from building a strategy to managing risk, but it all starts with the most critical foundation there is, you.
Okay, so where do we start? Well, before you can even dream of mastering the market, pretty much every single market wizard agrees on this one thing: you absolutely, positively must master yourself first. Seriously, this isn't just a friendly suggestion.
They see it as the price of entry. So you got to ask yourself, why do you really want to do this? Is it for the thrill? For the status? Or is it something deeper? You have to be honest, because the market is like this stern master that has an uncanny knack for finding and punishing any internal conflict you bring to the game. And this gets to a really critical idea, this need for alignment. On one side, you have the cerebral puzzle of it all, the research, the problem solving, but on the other, you have that gut-wrenching, visceral stress of having your money on the line. If you love one but can't stand the other, you're always fighting yourself. And the wizards are clear, in that state, the game is already lost. And this quote from Randy McKay just hits the nail on the head. There's no single best way to trade, period. The only best way is the one that fits you, your personality. It has to feel natural, almost like breathing. If you're trying to force a style that isn't you, it's a recipe for disaster. All right, so you've done the internal work, you know yourself. What's next? Well, now you've got to build your advantage. This isn't just some random tactics. It's a complete system, a blueprint for how you're going to approach the markets.
You absolutely have to have an edge. It's just non-negotiable. And what's an edge? It's just some method that gives you a statistical advantage over time. Without that, even if you have the discipline of a monk, all you're doing is guaranteeing you'll slowly bleed your account dry. It's like trying to beat the casino at roulette.
I mean, it's blunt, but it's so true. An edge isn't some vague gut feeling or a lucky streak. It's got to be specific, definable, repeatable. You need to be able to write it down on a piece of paper and explain it clearly. If you can't do that, you don't have one. Plain and simple.
And this is where things get really interesting, because it's a total paradox. The path to making it all look effortless, well, it's paved with a ton of hard work up front. Think about a world-class athlete. They look like they're just gliding, but that grace comes from thousands of hours of brutal training. It's the same with trading. The actual execution should feel smooth, not like a constant fight.
So when you put it all together, your edge, your specific methods, your rules for getting in and out, that becomes your trading plan. One of the wizards said trying to trade without a plan is like trying to build a house without blueprints. You're just guaranteeing that you'll make expensive and totally avoidable mistakes.
Okay, now we're getting to a topic that, believe it or not, almost every top trader said was even more important than how they pick their trades. And that's controlling risk. This is all about survival.
And a lot of them follow a simple, almost universal framework. Step 1, never ever risk more than 1 or 2% of your capital on any single trade. Step 2, you always, and I mean always, know your exit point before you even click the buy button. And step 3, if you hit a nasty losing streak, you just step away. Take a breather, clear your head.
And this quote from Stanley Druckenmiller, it reveals this really cool philosophy that the greats have. It's this mix of being super cautious, but also incredibly aggressive when the time is right. Most of the time, their number one job is playing defense, preserving capital. But when they get that rare, high-conviction idea, they go for the home run. They have the guts to be aggressive.
Okay, so let's recap. You know yourself. You've got a plan. You've got your risk nailed down. The battle now moves to the toughest battlefield there is, the one right between your ears. We're talking about the psychology of actually doing it. This quote from William Eckhardt is just so powerful. Think about it. Our brains are hardwired to want to feel good, to be comfortable. We want to take the easy, obvious trades. But the market, man, the market so often rewards doing the hard thing, buying when everyone else is freaking out, or selling when everyone is giddy. The right trade is very often the most uncomfortable one. And speaking of doing the hard thing, check out this quote from Jim Rogers. It's the perfect picture of extreme patience. The pros aren't clicking buttons all day. They're waiting, sometimes for weeks, sometimes even for months, until an opportunity is so screamingly obvious that it feels like just picking up free money.
Wow. I mean, if you need an analogy for this, Mark Weinstein gives us the absolute best one. The cheetah. It's the fastest thing out there, but it doesn't just run around like crazy. No, it waits. It waits for that perfect, high-probability setup. That, he says, is professional trading.
And here's another one of those totally backwards, counterintuitive truths that really separates the pros. You know that old saying, you can't go broke taking a profit? Well, the market wizards would tell you that's exactly how a lot of professionals go broke. They get scared and they cut their winners way too short, while amateurs do the opposite. They let their losers run, just hoping they'll come back.
All right, let's start pulling all of this together.
What's the big picture here? What's the mindset, the mental model that lets these traders operate at this insane level year in and year out?
This one might be the most shocking rule of them all. We are all taught that being right is the most important thing, but for these top traders, their win rate, it's the least important thing they track. They couldn't care less. They know they can be wrong 6, maybe 7 times out of 10 and still make a fortune because it's all about how much they make when they're right versus how little they lose when they're wrong.
So to get to that level of clear thinking, you have to be ruthless about getting rid of these things. Hope? They say it's a dirty word. It keeps you stuck in bad traits. Loyalty to a stock? No way. Your only loyalty is to your plan. Ego? You gotta check it at the door and be willing to admit when you're wrong, fast. And excitement? If you're looking for thrills, go to a casino. The market is a very expensive place to find them.
And this brings us to the final and maybe the most important piece of wisdom from these masters of the market, and that's to keep your perspective. They are obsessed with their craft, for sure, but they also know that it isn't the whole story of their lives. That balance is the secret to their long-term sanity and success.
So we've come full circle, right back to where we started, with a question just for you. After hearing all this, is the market a puzzle you are truly built to solve? Because at the end of the day, as we've seen, it's not about being the smartest person in the room. It's about alignment, it's about discipline, and it's about knowing yourself deeply. It's a journey into you first, and only then, a journey into the market.
Welcome to The Explainer. Today, we're diving into the world of trading. But forget the get-rich-quick stuff you see online. We're going to approach this just like our source material does, as a huge, intricate, intellectual challenge, this grand puzzle just waiting for someone to solve it.
So let's kick things off with this central idea. Winning in the markets isn't about some secret formula. You got to think of it like a master puzzle. You've got all these pieces lying around. Economic data, charts, human psychology, you name it. And the real art, the real challenge, is how you piece them together. It's a strategy game where your biggest edge isn't a secret indicator, it's just your own creativity.
All right, here's the game plan for this explainer. First, we're going to really frame the market as this ultimate puzzle. Then we'll get into what might be the most important puzzle piece of all, you. After that, we'll get our hands dirty with a specific tool, options, and we'll break down the strategy, figure out the price, and finally, learn to speak the language like a pro.
Okay, let's jump right into part 1. See, the market isn't just numbers on a screen. It's this living, breathing game that's always changing. So what is it that makes this puzzle so darn fascinating to so many people?
Well, it's that very complexity that makes it so addictive. Unlike chess where the rules are set in stone, the market's rules are constantly shifting. New tech pops up, a political event rocks the globe, investor psychology swings. The puzzle pieces are always in motion. There are a million ways to fail, and like the slide says, a whole bunch of really smart people will tell you it's impossible to win. And for a certain kind of person, there is just no better challenge than that.
Now here's where it gets really interesting. You'd think the key to this whole thing is some hidden algorithm or a secret chart pattern. But according to our source, the single most important lesson isn't out there in the market. It's in here. It's about you.
And this slide just lays it out perfectly. It shows 2 wildly different but equally successful styles. Over on the left, you have the author. He just can't stand the emotional roller coaster of making decisions second by second. It drains him. He needs a calm, systematic, rules-based plan. But then on the right, you have a legend, Paul Tudor Jones, who is the absolute opposite. The guy thrives in chaos. He's electric, just bubbling with energy, taking in 100 pieces of info at once and making split-second calls. He loves the action.
So what's the big takeaway here? It's that there is no single best way to trade. Paul Tudor Jones's hyperactive style would have been a total nightmare for the author. And it took the author over a decade to learn that. He was trying to trade on gut instinct, and it was just fighting his own nature. But the second he switched to a systematic approach, it fit like a glove. Finding a style that actually matches your personality, well, that's step 1, and it's the most important one. So, once you've got your head in the right space, it's time to start adding some powerful pieces to your puzzle. Let's talk about one of the most versatile and, honestly, most misunderstood tools out there, options.
Okay, there are 2 basic flavors here. First up, the call option. The easiest way to think about this is like putting a deposit down on a house. You pay a small fee, that's called the premium, to lock in a purchase price, that's the strike price, for a set amount of time. Now, if the value of that house skyrockets, you still get to buy it at that lower price you locked in. You're basically betting the price is going to go up. It's a bullish trade.
And the other type, that's the put option. It's the exact mirror image. A put gives you the right, but not the requirement, to sell something at a locked-in price. So why would you want that? Well, it's like buying insurance on your stock portfolio. If you think the market's about to tank, you buy a put. If the market does crash, your put option becomes way more valuable. You're betting the price is going down, it's a bearish trade. And that fee you pay? Just like with calls, it's called the premium.
Now this is really important. Every single trade needs two people. For every single person buying an option, there has to be someone on the other side selling it to them. And understanding their totally different goals, their totally different bets, well, that's absolutely essential.
And this table just nails the difference. Look at the buyer. The absolute most they can lose is the premium they paid. That's it. But if they're right, their potential profit is theoretically unlimited. Now flip that for the seller. Their absolute best case scenario is they get to keep the premium. That's their max gain. But if they're wrong, their potential loss is unlimited. So the buyer is basically buying a lottery ticket that could have a huge payout. And the seller, they're acting like the casino, happy to collect all those small ticket prices, hoping none of them hit the jackpot.
So this leads to a really critical question, right? When you look at that table, the seller's side of the deal looks, frankly, terrifying. Unlimited risk for just a little bit of gain, it seems like a sucker's bet. So why on earth would anyone ever want to be an option seller?
And the answer, the entire reason the seller's business exists, is one word: probability. The reality is, most options, especially the ones betting on crazy, wild price swings, expire completely worthless. So the seller isn't betting on which way the price will go. They're betting that a huge price move just won't happen before time runs out. They're playing the odds, collecting premium after premium, believing that the high chance of winning small will, over time, more than make up for that rare, low-probability event of a massive loss.
Okay, so we know buyers pay this thing called a premium and sellers collect it. But what actually determines how much that premium is? Where does that number come from? It's not just random, it's actually built from a few key ingredients.
It really all comes down to this simple but super powerful equation. An options premium has two parts: its intrinsic value and its time value. Intrinsic value is the easy part. It's any real, concrete value the option has right now. So, for example, if you have the right to buy a stock at $100 and it's trading at 105, well, your option has $5 of intrinsic value. Simple.
But the more interesting part, and often the bigger part of the price, is the time value. This is the amount you're paying for the potential for a future price move. And three things really pump up that potential. First is how close the option's strike price is to the real market price. Second is time itself. I mean, an option that expires in 6 months has way more potential for a big move than one that expires in 6 days, right? So it costs more. And finally, and this one is huge, is volatility. The choppier and wilder the market is, the greater the chance of a big price swing and the more valuable all that potential becomes.
All right, to really put all this together and understand what's going on, you gotta speak the lingo. So let's wrap this up with a quick hitter glossary of some essential terms you'll hear all the time.
First up is leverage. Options are basically a form of leverage. For a pretty small payment, that premium, you can control a much, much larger value of stock. This is what gives you that shot at unlimited profits. But, and this is a big but, it's a double-edged sword. It magnifies your losses just as quickly.
Next, drawdown. This is a huge concept for professional traders. It's not just about one bad trade. It's the total dip your account takes from its highest point down to its lowest. A trader's real skill isn't measured by their biggest win, but by how small they can keep their drawdowns when things go wrong.
You're going to hear these two all the time. It's super simple. A bull is an optimist. They think prices are going up. A bear is a pessimist. They think prices are headed down. So a rising market is a bull market, and a falling one is a bear market.
And finally, let's circle back to volatility. Now remember, this isn't just a vague feeling that the market is jumpy. It's a real, quantifiable number that measures how much a price is swinging around. And as we just saw, it's a direct and critical ingredient in the price of an option. More volatility means more expensive options, period. And that brings us right back to where we started. Full circle. We've talked about tools like options, ideas like probability, and words like volatility. But the real path to solving the market puzzle doesn't start with a chart or a fancy tool. It starts with taking a good, hard look in the mirror and asking yourself, what kind of person am I? What is my style? Because that is the first and most important piece of the entire puzzle. Thanks for joining this explainer.